Welcome to the Options Playbook, where we demystify the world of derivatives one strategy at a time. Imagine having the power to lock in a future price for a stock you're interested in, say 3 months from now, without the commitment of actually buying it today. It sounds like a financial superpower, but what are the trade-offs? What kind of power, and more importantly, what kind of risk does that truly give an investor?
That question is the very foundation of what we're exploring. Today, we're starting at the absolute beginning. We're going to peel back the layers on the fundamental building block of every complex strategy, the option itself. We'll define what an option contract is, break down the two primary types, calls and puts, and clarify the essential terminology you'll hear constantly: the underlying, the strike price, and the expiration date. And crucially, we'll look at the two sides of every trade: the buyer, who holds the rights, and the seller, who takes on the obligations.
Exactly. This isn't just about memorizing definitions. It's about building a solid mental model. Understanding these core components is non-negotiable because every single strategy, from the simplest covered call to the most complex iron condor, is just a combination of these basic pieces. Without a rock-solid foundation, the entire structure is unstable. So let's start with the most basic question of all. What precisely is an option?
At its core, an option is a contract. It's a formal agreement between two parties. This contract gives its owner the right, but critically, not the obligation, to either buy or sell a specific asset at a predetermined price on or before a specific date in the future. That phrase, right but not the obligation, is the conceptual key that unlocks everything.
It's the source of the name option. The holder has a choice to make. Let's think about that in a more tangible way. It's like putting a deposit down on a house. You might pay the seller a small fee to have the exclusive right to buy their house for, say, $500,000 anytime in the next 90 days. You've locked in the price. If you find a better house or decide you don't want to move, you're not obligated to buy. You simply walk away, losing only your initial deposit. But if the housing market suddenly booms and that house becomes worth $600,000, your right to buy it for $500,000 becomes incredibly valuable.
That's a perfect analogy. The deposit is what we call the premium in the options world. It's the price you pay for the choice, for the flexibility. And just like in your housing example, financial options come in two primary flavors that correspond to the two actions you can take: buying or selling. These are known as calls and puts.
Let's break those down. A call option gives the holder the right to buy an underlying asset at a specific price. You can remember this by thinking you are calling the asset away from someone else. If you are optimistic about a stock and believe its price will rise, you might buy a call option. It gives you the potential to profit from that upward movement.
And on the other side, a put option gives the holder the right to sell an underlying asset at a specific price. You are putting the asset to someone else. Puts are often associated with a pessimistic or bearish outlook where you believe a stock's price is going to fall. It can be used to profit from a decline or, very commonly, to act as insurance to protect an existing stock position from a downturn.
So within every contract, whether it's a call or a put, there are three critical components that define its terms. These are the DNA of the option. They are the underlying asset, the strike price, and the expiration date.
Let's make that concrete. The underlying asset is simply the what of the contract. Most often for our listeners, this will be a stock like Apple or Tesla, but it can also be an ETF, an index, or even a commodity. It's the thing you have the right to buy or sell.
Next is the strike price. This is the at what price part of the contract. It's the fixed, predetermined price at which the transaction will occur if the option owner decides to exercise their right. It doesn't matter if the stock's market price has soared to the moon or dropped through the floor. The strike price is locked in for the life of the contract.
And finally, the expiration date. This is the buy when. Every option has a shelf life. The expiration date is the final day on which the owner can choose to exercise their right. If they don't exercise it by that date, the contract expires, it ceases to exist, and it becomes completely worthless. The choice is gone.
So, putting it all together, you could have a call option on Acme Corp.
That's the underlying. The contract gives you the right to buy Acme shares at a strike price of $110 per share, and you must exercise this right on or before the expiration date, which might be the third Friday of next month. Every element is clearly defined. Now, this brings us to the two roles in this transaction, the person buying this right and the person selling it.
Let's talk about the buyer first, because it's the more intuitive side. The option buyer pays a fee, the premium we mentioned earlier, to acquire the rights granted by the contract. For the call buyer, it's the right to buy the stock. For the put buyer, it's the right to sell. The absolute most a buyer can ever lose is the premium they paid up front. Their risk is strictly defined and limited. This is a crucial concept.
The other side of that coin is the option seller, often called the writer, because they are the one creating or writing the contract. In exchange for receiving the premium from the buyer, the seller takes on an obligation. If the call buyer decides to exercise their right to buy the stock, the call seller is obligated to sell them their shares at that strike price, regardless of how high the market price has gone.
And for a put, if the put buyer exercises their right to sell, the put seller is obligated to buy the stock from them at the strike price, no matter how far the stock may have fallen. This is where the risk profile changes dramatically. While the buyer's loss is capped at the premium paid, the seller's potential loss can be substantial, even unlimited in some cases. Their profit, however, is capped at the premium they received. They are trading limited, known profit for potentially large, unknown risk.
This is best understood with a clear example. Let's go back to Acme Corp. Let's say its stock is currently trading at $100 a share. You are an analyst, and you've done your research. You believe the company is about to launch a revolutionary product, and you expect the stock price to soar in the near future. You could buy the stock, but that requires a significant capital outlay. Instead, you decide to use options.
You look at the options market and find an Acme call option with a strike price of $110 that expires in 2 months. The market is charging a premium of $3 per share for this contract. So you buy one contract, which typically represents 100 shares, paying a total of $300. You now own the right, but not the obligation, to buy 100 shares of Acme at $110 each anytime in the next 2 months.
Now let's play out two possible futures. In the first scenario, your analysis was spot on. Acme launches its product and the market goes wild. The stock shoots up to $120 per share before your option expires. What happens now?
You exercise your right. Your contract allows you to buy 100 shares at your strike price of $110, even though they're trading on the open market for $120. You could immediately sell them on the market for a $10 per share profit. That's a $1,000 gross profit on your 100 shares. But remember, you paid a $3 per share premium, or $300 total. So your net profit is $1,000 minus the $300 cost, which equals $700. You controlled 100 shares of a rising stock for a fraction of the cost of owning them, magnifying your returns.
But what about the second scenario? What if the product launch is a dud, or the market simply shrugs? The stock price languishes and stays below your 110 strike price for the entire 2 months. On the expiration date, it's trading at 105.
In this case, your right to buy the stock at 110 is useless. Why would you pay $110 for something you can buy on the open market for $105? You wouldn't. So you do nothing. Your option contract expires worthless. Your choice is gone. What have you lost? Only the $300 premium you paid for the right. Your downside was capped. You took a calculated shot at a big upside with a clearly defined and limited risk.
Now let's flip the script completely to understand puts. Imagine a different situation. You already own 100 shares of Acme Corp, which you bought a while ago, and they're currently trading at $100. You've had a good run, but you're now worried about a potential market correction or some bad news for the company. You don't want to sell your shares yet, but you want to protect your position from a potential drop.
You can use options as an insurance policy. You decide to buy an Acme put option with a strike price of $90, expiring in 1 month. The premium for this put is $2 per share, so you pay $200 for one contract. This contract now gives you the right to sell your 100 shares at $90 each, no matter how low the price might fall.
Let's follow the two paths again. First, the pessimistic scenario. Your fears are realized. A negative earnings report comes out, and Acme stock plummets to $70 per share. Other investors are panicking, but you hold your put option.
Exactly. You exercise your right. You sell your 100 shares at the guaranteed strike price of $90, even though they are only worth $70 on the market. You effectively avoided an additional $20 per share loss. The insurance paid off. Your net gain from this protective strategy is that $20 per share of avoided loss minus the $2 per share you paid for the premium. So you are $18 per share better off than someone who just held the stock without protection.
And in the optimistic scenario, the bad news never comes. The stock continues to trade above your $90 strike price, maybe even rising to $110. What happens to your put option?
It expires worthless. Your right to sell at $90 is of no value if the market price is $110. You let the contract expire. Your 100 shares have increased in value, and the only thing you've lost is the $200 premium. In this case, the premium was simply the cost of your financial peace of mind for that month. It was the price of your insurance policy, which, thankfully, you didn't need.
So, when we boil it all down, the fundamental takeaway is this. An option is a choice that you purchase. As an option buyer, you are paying a premium for the possibility of a large upside with a strictly defined and limited downside. Your risk is known from the very beginning. It's the price of the option and not a penny more.
And on the other side of that transaction, the seller is collecting that premium as their defined profit. In exchange for that upfront cash, they are accepting an obligation and the open-ended risk that comes with it. They are essentially selling a choice or selling insurance and hoping that it never gets used. Understanding this fundamental dynamic, the transfer of rights and obligations for a premium, is the first and most critical step in mastering the options playbook.
Welcome back to the Options Playbook. Last time, we established what an option is, a contract giving you the right, but not the obligation, to buy or sell an asset. But knowing the concept is one thing, putting it into practice is another. When you first open a trading platform and look at the options for a stock, you're not faced with one choice, but a wall of data, a grid of numbers and dates that can feel overwhelming. How do you translate that theoretical contract into a specific trade from that grid?
That grid is called the option chain, and it's the real-world marketplace for the contracts we discussed. It's where theory meets execution. Today, we're going to demystify it completely. We'll break down how to read that chain by focusing on its core components, the strike price and the expiration date. Then we'll dive into the crucial concept of moneyness, what it means for an option to be in the money, at the money, or out of the money. From there, we'll dissect the option's price, its premium, into its two key ingredients, intrinsic and time value. And finally, we'll touch on the practical realities of trading, like the bid-ask spread and why liquidity is so important.
This feels like the essential next step. If our last discussion was about learning the rules of the game, today is about learning how to read the scoreboard and understand the pieces on the board. Without this, you can't make an informed move.
Exactly. This is the foundational skill for constructing any strategy. Let's start with the two most prominent columns you'll see in any option chain, strike price and expiration date.
The expiration is the date the contract ceases to exist. These can be short-term, like weekly options that expire every Friday, or even daily options known as 0 DTEs, 0 days to expiration, which are very high risk. Or they can be much longer, with standard monthly expirations or even contracts that last for years known as leaps.
So the expiration date sets the lifespan of your trade, and the strike price? That's the price at which the contract allows you to buy or sell the underlying stock.
Precisely. For a call option, the strike is your potential purchase price. For a put option, it's your potential selling price. A single stock will have dozens of available strike prices listed at any given time, some below the current stock price, some at it, and some well above it. The combination of a specific strike price and a specific expiration date defines a unique option contract.
And this is where that term you mentioned, moneyness, comes into play. It describes the relationship between the option strike price and the current market price of the stock. Let's break that down.
Absolutely. Moneyness is a simple concept that tells you if your option would have immediate, exercisable value if it expired right now. There are 3 states. First is at the money, or ATM. This is when the option strike price is very close or identical to the current stock price. If a stock is trading at $100.15, the 100 strike option is considered at the money.
Okay, that's straightforward. What about the other 2 states?
Next is in the money, or ITM. An option is in the money if it has intrinsic value. For a call option, this means the stock price is above the strike price. If our stock is at 105, a call option with a 100 strike is $5 in the money. You have the right to buy at 100 what is currently worth 105. For a put option, it's the reverse. A put is in the money when the stock price is below the strike price. If the stock is at $95, a put with a 100 strike is $5 in the money, because you have the right to sell at 100 what is only worth 95. And the final state must be out of the money, or OTM. This would mean the option has no intrinsic value. For a call, the stock price is below the strike, and for a put, the stock price is above the strike. Exercising it would be illogical.
You've got it. A 110 strike call is out of the money if the stock is at 105. Why would you exercise your right to buy at 110 when you can buy it on the open market for 105? It's currently worthless from an exercise standpoint. Understanding moneyness is the first step in decoding why different options have different prices.
This makes me think of the option chain as a large menu at a restaurant. Each item on the menu is a specific combination of a strike and expiration date.
That's a perfect analogy. Let's stick with our stock trading at $100. The option chain is the menu. The at-the-money option, the 100 strike call, is like the house special. It's priced moderately and gives you a roughly 50-50 shot of being profitable if the stock moves. Now look further down the menu to the out-of-the-money options. A 105 strike call might be listed for a premium of just $2. This is the cheap, high-risk, high-reward dish. It costs less, but the stock needs to rally more than 5% just to break even.
And on the other side of the menu, you have the in-the-money options. The 95 strike call, for instance. That one would be more expensive.
Much more expensive. It might cost $8. This is the premium, deluxe item on the menu. It's pricey, but it comes with a head start. The stock is already at $100 and your strike is $95, so that option already has $5 of what we call intrinsic value built into its price. You are paying a higher price for a higher probability of success. The moneyness of an option, where it sits on that menu, tells you a great deal about the trade-off you are making between cost and probability.
You've mentioned intrinsic value a couple of times now. You said the premium for that 95 strike call was $8, but its intrinsic value is only $5. What makes up the other $3? This seems to be the core of understanding an option's price.
It is. The premium of any option is made up of 2 and only 2 components: intrinsic value and extrinsic value, which is more commonly called time value. We just defined intrinsic value. It's the amount by which an option is in the money. It's real, calculable value. An out-of-the-money option, by definition, has 0 intrinsic value.
So that entire $2 premium for the out-of-the-money 105 call is what? Hope?
In a way, yes. That is its time value. Time value is the portion of an option's premium that is attributable to the amount of time remaining until the expiration of the contract. It's the risk premium that the seller of the option demands to take on the obligation. It represents the possibility, or the hope, that the stock price will move favorably before the expiration date, turning an OTM or ATM option into a profitable ITM option. The more time an option has until it expires, the higher its time value will be, because there's more time for the stock to make a significant move.
So if we go back to the 95 strike call priced at $8 when the stock is at $100, its premium is $8. Its intrinsic value is the stock price minus the strike price, so 100 minus 95, which is $5. Therefore, its time value must be the remaining $3.
Exactly. And that time value is not static. It decays every single day, a phenomenon known as theta decay. The value erodes like a melting ice cube, accelerating as you get closer to the expiration date. On the final day, at expiration, all time value is gone. An option's price will be equal to its intrinsic value and nothing more. That OTM call with the 105 strike will be worth zero.
This brings up a critical point for anyone looking at an option chain. The price you see quoted isn't a single number. There's a bid price and an ask price. What do those represent, and why is the gap between them, the spread, so important?
This is a crucial practical detail. The bid price is the highest price a buyer is currently willing to pay for that option. The ask price, or offer price, is the lowest price a seller is willing to accept. The difference between them is the bid-ask spread. For a trader, this spread is an implicit transaction cost. When you buy, you typically pay the ask price, and when you sell, you receive the bid price.
So a wide spread can immediately put your trade at a disadvantage.
A significant one. Imagine an option with a bid of 180 and an ask of 220. The spread is 40 cents. If you buy it at 220, its immediate market value, if you had to sell it back, is only 180. The underlying stock hasn't even moved, and you're already down 18%. This is why liquidity is paramount. Options on popular, high-volume stocks and ETFs will have very tight spreads, maybe just a penny or two wide. This indicates a healthy, active market where you can enter and exit trades efficiently. Illiquid options on obscure stocks can have enormous spreads that make profitable trading nearly impossible. Always check the trading volume and the open interest, the number of outstanding contracts, before entering a trade.
It seems we've gone from a confusing grid of numbers to a structured menu of choices, each with a clear trade-off. You can choose a cheap, out-of-the-money option that requires a big move but offers high leverage, or a more expensive, in-the-money option that costs more but has a higher probability of success and a built-in head start.
And that is the central lesson. The option chain isn't just data. It's a landscape of probabilities and trade-offs. By understanding strike, expiry, moneyness, and the components of premium, you can start to navigate that landscape. You can select the precise contract that aligns with your specific forecast for the stock, how much you think it will move, and in what time frame. You're no longer just guessing. You're making a calculated decision based on risk, reward, and probability.
So the key takeaway is that reading an option chain is about deciphering the story each option tells. Its moneyness and premium reveal the market's baked-in expectations, presenting you with a spectrum of choices, from low-cost, low-probability bets to high-cost, high-probability positions.
That's the perfect summary. It's about understanding the trade-off between the premium you pay, which is your risk, and the probability of that option finishing in the money. Lower premium OTM options are lottery tickets that need a big move to pay off, while higher premium ITM options give you that head start, but at a greater initial cost, which inherently caps your percentage profit potential. Your job as a trader is to find the right balance for your strategy.
Welcome back to the Options Playbook. Last time, we navigated the intricacies of the option chain, deciphering strike prices, expiration dates, and the concept of moneyness. We learned to read the menu, so to speak. But reading the menu is one thing. Knowing why you'd order a particular dish is another entirely.
Exactly. So you see that your favorite stock went up 10% this year. A solid return. But the question that should follow is, could you have done better? Could you have potentially earned more with the same capital? Or perhaps more importantly, could you have protected your portfolio against the inevitable downturns and still captured a portion of that upside? That's the playbook we're opening today.
It's a critical question. Many see options as just a way to make leveraged bets on market direction. And while that's certainly one application, it's a bit like using a sophisticated surgical tool as a simple hammer. Today, we're moving beyond the what and delving deep into the why. We'll explore the three primary strategic functions of options: creating leverage, generating consistent income, and building insurance for your portfolio.
Understanding these three pillars is what separates a gambler from a strategist. They are the foundational reasons options even exist. We'll break down how you can use a small amount of capital to control a large stock position, how you can effectively get paid to own stocks you already like, and how you can sleep better at night knowing you have a defined floor on your potential losses. This isn't just theory, it's about transforming your entire approach to portfolio management.
Let's start with the most famous and perhaps most misunderstood use of options: leverage. The basic idea is to control a large asset with a small amount of money. In the stock world, if you want the profit and loss exposure of 100 shares of a $100 stock, you need to fork over $10,000. It's a 1-to-1 capital requirement.
But options completely change that equation. Let's say you're bullish on that same $100 stock. Instead of buying 100 shares for $10,000, you could look at the option chain. You might find a call option with a strike price of, say, $100 that expires in 2 months, and it might cost you $3 per share. Since one option contract typically represents 100 shares, your total cash outlay to purchase that call option is just $300.
So for just $300, you now have the right but not the obligation to buy those 100 shares at $100 anytime in the next 2 months. You are effectively controlling a $10,000 position for a fraction of the cost. If the stock rallies to 110, your option is now worth at least $10, giving you a $7 profit per share or $700 total. Your initial $300 investment more than doubled.
And that's the power of leverage. A 10% move in the underlying stock resulted in over a 200% return on your capital. Had you bought the stock outright for $10,000, that same 10% move would have netted you a $1,000 profit, which is only a 10% return on your invested capital. The amplification is immense.
Of course, there's no free lunch. The flip side of that leverage is significant risk. If the stock doesn't move above $100 by expiration, or even if it just stays flat, your option expires worthless. Your $300 is gone, a 100% loss. Whereas the stockholder, who bought the shares for $10,000, still holds an asset worth $10,000. They've lost nothing but the opportunity cost. The leverage magnifies both gains and losses.
That's the critical trade-off. You're paying a small premium for the potential of outsized returns, but you're also taking on the risk of losing that entire premium if your timing or direction is wrong. This is the speculative use of options. It's high risk, high reward, and it's what draws many people in. But it's only one chapter in the playbook. A far more common and, for many, more sustainable use is for generating income.
This is where things get really interesting for long-term investors. Let's say you already own those 100 shares of the $100 stock. You're happy holding it, but you believe it's likely to trade sideways or only move up slightly in the near term. You can use options to essentially rent out your shares.
Think of it like owning an investment property. You own the house, and you can generate income by renting it out to a tenant. With stocks, you can do something similar by selling a call option against your shares. This is known as a covered call. Using our example, you own 100 shares of the stock at $100. You could sell one call option with a strike price of $110 that expires in 1 month. For selling this option, you might receive a premium of, let's say, $3 per share or $300 in total cash deposited into your account immediately.
So what have you just done? You've promised to sell your 100 shares at $110 if the buyer of the call option chooses to exercise their right. In return for making that promise, you received $300. Now let's consider the outcomes. If the stock price stays below $110 by expiration, the option expires worthless. The buyer won't exercise their right to buy at $110 when they can buy it cheaper on the open market.
In that scenario, you keep the $300 premium and you also keep your 100 shares. You've just generated a 3% return on your hypothetical $10,000 position in just 1 month from a stock that didn't even have to go up. You also have a small cushion. If the stock falls to $97, the $3 per share loss on your stock is completely offset by the $3 premium you collected. You've effectively lowered your cost basis.
Now, what if you are wrong and the stock soars to $120? The buyer of the call will absolutely exercise their right to buy your shares at the agreed-upon strike price of $110. So you sell your shares for $110 each. Your total gain is the $10 per share appreciation from $100 to $110 plus the $3 premium you collected. That's a $13 gain per share or $1,300. It's a fantastic, defined return.
The catch, of course, is that you missed out on the gains between $110 and $120. Your upside was capped, but you made a conscious trade-off. You exchanged unlimited upside potential for a guaranteed income stream and a small amount of downside protection. This is a conservative strategy used by countless investors to enhance their returns on stocks they already own. It's not about hitting home runs, it's about consistently getting on base.
And this income strategy isn't limited to selling calls. You can also sell puts. A cash-secured put involves selling a put option on a stock you wouldn't mind owning at a lower price. You collect a premium, and if the stock drops below your strike price, you're obligated to buy the shares, but at the price you wanted anyway, and with the premium you received effectively lowering your purchase price even further. It's a way to get paid to wait to buy a stock.
So we have leverage for speculation and premium selling for income. That brings us to the third critical function, insurance or hedging. This is about protecting your existing portfolio from a significant loss. It's perhaps the most prudent and professionally utilized aspect of options trading.
Let's go back to our investor who owns 100 shares of that $100 stock. Let's say the company has an earnings report coming up, or there's some broader market uncertainty. The investor is worried about a sharp, sudden drop, but they don't want to sell their shares and trigger a taxable event or miss out on potential upside if the news is good. They can buy insurance.
In the options world, this insurance policy is called a protective put. The investor could buy one put option with a strike price of, say, $90 that expires after the earnings announcement. This might cost them $2 per share or $200 total. A put option gives the owner the right to sell shares at the strike price.
Now, let's look at the protection this provides. If the earnings are disastrous and the stock plummets to $70, the investor's position would normally have lost $3,000. But because they own the $90 put, they can exercise their right to sell their shares for $90 each, even though the market price is only $70.
Their maximum loss is now capped. The stock fell from 100 to their floor of 90, which is a $10 loss per share. You also have to account for the $2 per share cost of the insurance, so their total loss is limited to $12 per share, or $1,200. That's a lot better than the $3,000 loss they would have otherwise suffered. They paid a premium for a defined risk outcome, just like any insurance policy. If the stock goes up, the put option expires worthless, and they've only lost the $200 they paid for the insurance, a small price for peace of mind and protection against catastrophe.
These strategies allow traders to express incredibly nuanced views that simply aren't possible with stocks alone. If you think a stock will stay within a specific range, there are strategies for that. If you believe volatility is about to increase or decrease regardless of direction, there are option strategies to profit from that. It diversifies not just your assets, but your entire strategic approach to the market.
It's the difference between having a single tool, buy or sell, and having a full toolkit. You can be bullish, but with a hedge. You can be neutral, but still generate income. You can be bearish, but with a clearly defined and limited risk. The flexibility is immense, but it all comes back to these three core purposes.
So, the key takeaway here is that options are far more than just lottery tickets. They are sophisticated financial instruments that can be used to fundamentally alter the risk and reward profile of your stock portfolio.
Exactly. You can use them to amplify your returns through leverage, understanding that you are also amplifying your risk. You can use them to generate a consistent stream of income, agreeing to cap your potential upside in exchange for that cash flow. Or you can use them to generate a powerful form of insurance, paying a premium to protect yourself from significant downside losses. The choice of strategy depends entirely on your goals, your risk tolerance, and your outlook for the underlying asset.
Welcome back to the Options Playbook. Last time, we explored the why of trading options, using them for everything from leverage to income to portfolio insurance. Today, we're peeling back the next layer and diving deep into the how, specifically how an option gets its price.
It's a critical question, and one that trips up a lot of traders. You might buy a call option, see the stock price go up, but your option's value barely moves. Or worse, you wake up, the stock is completely flat, but your option has lost value overnight. It feels like there are hidden levers at play, because there are.
Exactly. It's not as simple as the stock price versus your strike price. An options premium is a bundle of different components. To really understand what drives an options price, we need to unpack how it's constructed. We'll be looking at the difference between intrinsic and extrinsic value, the core factors that determine an option's theoretical price, and then we'll zero in on the two biggest forces that surprise traders: time and volatility.
Understanding these components is the bridge between simply buying a call or a put and truly engineering a trade. It's about knowing which forces are working for you and which are working against you.
Let's start with the most straightforward piece of the puzzle. An options price is made of two parts: intrinsic value and extrinsic value. What is intrinsic value?
Intrinsic value is the tangible, here and now value of the option if it were exercised today. It's the amount by which an option is in the money. For a call option, the intrinsic value is the current stock price minus the strike price. For a put option, it's the strike price minus the current stock price. Crucially, if the result of that calculation is negative, the intrinsic value is simply zero. It can't be less than that.
So if a stock is trading at $52 and you own a call option with a $50 strike price, its intrinsic value is $2. It has a real calculable value of $2 per share because you have the right to buy something worth $52 for just $50.
Precisely. Now, if that same stock was trading at $48, your $50 strike call option would have zero intrinsic value. The right to buy a $48 stock for $50 isn't worth anything at this moment, so it's considered out of the money.
But that option, even if it's out of the money, still has a price. You still have to pay for it. That brings us to the second, more abstract component: extrinsic value. If intrinsic value is the now value, what is extrinsic value?
Extrinsic value is everything else. It's the portion of the option's premium that isn't intrinsic value. You can think of it as the hope or potential value. It's the price traders are willing to pay for the possibility that the option could become profitable before it expires. This value is driven by several factors, but the two heavyweights are the time left until expiration and the expected choppiness of the stock, known as implied volatility.
This is where the famous Black-Scholes model comes into play. It was the first widely used mathematical model for option pricing, and it identifies the key inputs needed to calculate a theoretical fair value. The big ones are the stock price, the strike price, the time to expiration, and the stock's volatility. It also includes factors like interest rates and dividends, though their impact is generally smaller.
Right, and understanding those inputs helps us deconstruct extrinsic value. Let's start with time. All else being equal, an option with more time until expires is more valuable. There's simply more opportunity for the stock to make a favorable move. This time component of extrinsic value is what gives rise to a powerful and often costly force in options trading: time decay.
This is the phenomenon that caused our hypothetical trader's option to lose value overnight, even when the stock price didn't budge.
Exactly. Time decay is the gradual erosion of an option's extrinsic value as the expiration date gets closer. Think of an option's time value like a melting ice cube. Every single day, a little bit of it melts away, and there's no way to stop it. That daily loss in value is represented by one of the option's Greeks called theta.
So if an option has a theta of, say, negative 0.05, it means that, in theory, it will lose 5 cents of its value every day, assuming the stock price and volatility stay the same.
Correct. And this decay isn't linear. It accelerates. The melting gets faster and faster as you approach the expiration date. In the final 30 days of an option's life, the rate of time decay picks up dramatically. This is why holding on to a losing option, hoping for a miracle in the final week, can be so destructive. Its value is evaporating at an incredible speed. For option buyers, time is the enemy. For option sellers, it's their greatest ally.
That makes sense. The clock is always ticking. But what about the other major component of extrinsic value? The one that can suddenly make an option's price explode or implode, even if time and the stock price are constant. I'm talking about volatility.
Volatility is the secret sauce of option pricing. Specifically, we're talking about implied volatility. This isn't a measure of how much a stock has moved in the past. It's the market's collective guess about how much it's going to move in the future. It represents the level of uncertainty or anticipation surrounding a stock.
So a high implied volatility means the market expects a big price swing, and a low implied volatility means it expects things to be relatively calm.
Exactly. And this expectation has a direct and powerful effect on an option's price, which is measured by another Greek called Vega. Vega tells you how much an option's price will change for every 1 percentage point change in implied volatility.
Can you give us an analogy for how that works?
Think of it like buying insurance. If you want to buy homeowners insurance and there's a hurricane forecast for next week, the premium is going to be incredibly high. The expectation of a volatile event makes the insurance more valuable. It's the same with options. If a company has an earnings report coming out or there's a major industry announcement expected, the uncertainty is high. This drives up implied volatility, which inflates the extrinsic value of both calls and puts, making them more expensive.
So as a trader, you could be right about the direction of a stock, but if you buy options when implied volatility is very high, right before that earnings report, for instance, you're paying a huge premium. If the news comes out and the stock moves as you expected, but not dramatically, the implied volatility can collapse, crushing the extrinsic value of your option.
That's a classic trap. It's called volatility crush. The hurricane passes without hitting your house, the uncertainty vanishes, and the price of that insurance policy plummets, even if there was some wind and rain. You might win on the stock's direction, but lose on the change in volatility. This is why just buying calls or puts isn't enough. You have to have an opinion on volatility as well.
We should briefly touch on the other two factors from the Black-Scholes model: interest rates and dividends. They are less significant for most short-term traders, but are still part of the equation.
They are. Generally, higher interest rates will slightly increase the value of call options and decrease the value of put options. The logic for calls is tied to carrying costs. Buying a call is cheaper than buying the stock, and the cash you didn't spend on the stock can earn a higher rate of interest.
And for dividends?
Dividends have the opposite effect. When a stock pays a dividend, its price is expected to drop by the dividend amount on the ex-dividend date. Because of this expected price drop, call options become slightly less valuable and put options become slightly more valuable as dividend payments increase. But again, for most retail traders focused on options expiring in a few weeks or months, the effects of time decay and implied volatility are vastly more important.
So, to bring it all together, an options price isn't just a simple bet on direction. It's a dynamic price based on its intrinsic value, its current worth, plus a complex extrinsic value premium.
And that premium is a constantly shifting balance. It's a function of time, which is always bleeding value away, and implied volatility, which reflects the market's fear or excitement. Understanding that interplay is what separates guessing from strategy. An options price isn't just about where the stock is now. It's a reflection of where it might go, how fast it might get there, and how much time is left for it to happen.
Welcome to the Options Playbook. In our last session, we cracked open the engine of an options price, looking at the big forces that drive its value: the underlying stock price, the relentless passage of time, and the ever-shifting winds of volatility. But knowing the forces is one thing. Measuring their precise impact is another. What if you wanted to know, down to the dollar, how a change in the stock price will affect your option?
That's the real question, isn't it? It's the difference between knowing that pressing the accelerator makes a car go forward and knowing that pressing it this much will increase your speed by exactly 10 miles per hour. Today, we're moving from the what to the how much. We'll be zeroing in on two of the most critical metrics in any trader's toolkit, delta and gamma. We'll explore what delta tells us about an option's sensitivity to price changes, and then uncover how gamma reveals the hidden acceleration within that sensitivity.
Exactly. After our last discussion on the core components of an option's price, understanding delta and gamma is the logical next step. It allows us to quantify the relationship between the S, the stock price in the Black-Scholes model, and the premium of the option itself. This isn't just theory, it's the foundation of hedging, risk management, and structuring sophisticated trades. So, let's start with the most direct question a trader can ask. The stock just moved up by $1. What happens to my option's value?
That $1 question is answered by delta. In the simplest terms, delta is the expected change in an options price for a $1 move in the underlying stock. It's often called the hedge ratio for a reason. If you have a call option with a delta of 0.50, you can expect its price to increase by about 50 cents if the stock rallies by $1.
And conversely, if the stock were to fall by $1, that same option would lose about 50 cents in value. It's a direct first-order measure of directional exposure.
Precisely. And this is where the type of option really matters. Call options always have a positive delta, ranging from 0 to 1. They move in the same direction as the stock. A delta of 1 would mean the option's price moves penny for penny with the stock, essentially behaving like the stock itself. This is what you see in very deep in-the-money calls.
On the other side of that coin are put options, which have a negative delta, ranging from 0 down to -1. They move in the opposite direction of the stock. A put option with a delta of -0.50 would be expected to gain 50 cents in value if the underlying stock falls by $1.
And there's a very intuitive anchor point in all of this, at-the-money options. An option whose strike price is exactly the same as the current stock price has roughly a 50-50 chance of expiring in the money. Because of this, its delta hovers right around 0.50 for a call or -0.50 for a put. It has the potential to move towards a delta of 1 if it goes deep in the money or towards 0 if it goes far out of the money.
This concept is so fundamental because it allows us to translate option positions into share equivalents. If a portfolio manager holds a call option contract, which represents 100 shares, with a delta of 0.60, the immediate directional risk of that position is equivalent to holding 60 shares of the actual stock. For a $1 move up, both positions would gain approximately $60.
This is the bedrock of delta hedging. If you are long 1,000 shares of a stock and want to protect against a small downward move, you could buy put options. If you choose puts with a delta of -0.50, you would need 20 contracts. That's 20 contracts times 100 shares per contract, which is 2,000 share equivalents times the -0.50 delta. The result is a delta of -1,000, which perfectly neutralizes the +1,000 delta from your stock position.
For a moment at least, and this is where the seemingly simple world of delta gets complicated. Delta is not a static number, it's a snapshot in time. The very stock movement you are trying to hedge against will cause your option's delta to change. Your perfectly balanced hedge from 5 minutes ago could be out of alignment now.
That is the critical limitation of relying on delta alone. Think of delta as the speedometer in your car. It tells you your exact speed at this very instant, but it tells you nothing about whether you are pressing the accelerator or the brake. That rate of change, the acceleration, is governed by our second Greek for today, gamma.
Gamma is the delta of the delta. It measures the rate of change of an option's delta for every $1 move in the underlying stock. If delta is speed, gamma is acceleration. A position with high gamma is like a high-performance sports car. Its speed can change very, very quickly.
Let's make that concrete. Suppose we have an at-the-money call option with a delta of 0.50, and let's say its gamma is 0.05. If the stock price rallies by $1, two things happen. First, the option's price increases by about 50 cents, as predicted by delta. Second, the option's delta itself changes. The new delta will be the old delta plus the gamma, so 0.50 plus 0.05, giving us a new delta of 0.55.
And that has significant implications for the next dollar move. If the stock rallies by another dollar, from 101 to 102, the option's value won't increase by another 50 cents. It will now increase by its new delta, which is 55 cents. The gains are accelerating. This is positive gamma at work, and it's a feature of any long option position, whether it's a call or a put.
This acceleration is most pronounced under specific conditions. Gamma is at its highest for options that are at the money and very close to their expiration date, and this makes perfect sense intuitively. Think about an at-the-money option with 1 day left until it expires. Its fate is hanging on a knife's edge. A small move in the stock price can be the difference between it expiring worthless or expiring in the money.
In that scenario, its delta has to make a very rapid journey. It might be at 0.50 right now, but by the end of the day, it must resolve to either 1 if it finishes in the money or 0 if it finishes out of the money. That necessity for a rapid change in delta is what high gamma represents. It's a measure of the instability or sensitivity of the delta itself.
It creates a powerful visual if you imagine the profit and loss graph of an option. For a long call, it's not a straight line. It's a curve that gets steeper as the stock price rises. That curvature is gamma. For someone who owns the option, this is a wonderful thing. Your gains accelerate to the upside, while your losses, which are capped at the premium you paid, decelerate on the downside. The PL line flattens out as the stock falls.
But every trade has two sides. For every long option holder enjoying that positive gamma, there is an option seller on the other side who is short gamma. And for them, the situation is the inverse and potentially treacherous. Their P&L curve is concave. As the stock moves against them, their losses accelerate.
And this creates the classic challenge for option sellers, particularly market makers. They might sell a call and hedge it by buying stock to remain delta neutral. But as soon as the stock rallies, the call's delta increases because of gamma. They are no longer hedged. They are effectively short the market, so they have to buy more stock at a higher price to rebalance. If the stock then falls, the call's delta decreases, leaving them too long, and they have to sell stock at a lower price to rebalance again. This constant buying high and selling low to manage a short gamma position is known as gamma scalping, and it can be a significant drag on profitability.
So, in practice, delta gives you your immediate first-order risk exposure. It's the answer to, what is my position equivalent to in shares right now? Gamma, on the other hand, is your second-order risk. It's the answer to, how quickly will my directional exposure change if the market moves? Ignoring gamma is like driving a race car while only looking at the speedometer and never at how hard your foot is pressing the pedal.
A trader needs to be constantly aware of both. If you construct a portfolio that is delta neutral but has high positive gamma, you are not making a bet on direction but on movement itself. You will profit if the stock makes a large move in either direction. Conversely, a delta neutral short gamma position is a bet that the market will stay quiet. You collect the premium, but you are exposed to significant losses if there is a sharp price swing.
Which brings us back to where we started. We moved from understanding the broad forces on an option to quantifying the specific impact of a stock price move. Delta provides that initial linear approximation. It's our best guess for the next small step.
But gamma tells us that the path is not a straight line, it's a curve. It warns us that our exposure is dynamic and that our hedges are temporary. It quantifies the acceleration of our risk and reward. To truly understand an options position, you cannot know one without the other.
So the key takeaway is really twofold. Delta is your indispensable guide to an option's immediate price sensitivity, your exposure to the market's next move. But gamma is the crucial and often overlooked indicator of how stable that exposure is.
Exactly. Knowing your delta tells you where you are on the map. Knowing your gamma tells you whether you're standing on solid ground or on a tectonic plate that's about to shift. Mastering both is essential for navigating the complex and dynamic landscape of options trading.
Welcome back to the Options Playbook, where we demystify the forces that move option prices. Last time, we dissected how an option's value reacts to the underlying stock's price, focusing on the critical roles of delta and gamma. But what if the stock price doesn't move at all? Can you still lose money? Or, conversely, can you make a profit even if you get the direction wrong?
That's the fascinating paradox we're diving into today. The price of an option is a living, breathing thing, influenced by more than just the stock's direction. We're going to explore the two other primary forces that are constantly at play: the relentless march of time and the fickle nature of market sentiment. Have you ever watched an option's value just melt away as the expiration date gets closer, even when the stock is stagnant? Or seen its price suddenly explode upwards after a news announcement before the stock has even had a chance to react?
Exactly. Those are the phenomena we're unpacking. We'll be looking at Theta, the measure of time decay, and Vega, which quantifies the impact of changes in volatility. We'll also examine a powerful and often painful effect for option buyers known as IV crush, which can decimate an option's value after a major event.
Understanding these concepts is non-negotiable for any serious options trader. While delta and gamma tell you about your exposure to price changes, Theta and Vega reveal your exposure to the passage of time and shifts in market fear. Mastering them is the key to transitioning from simply betting on direction to strategically managing risk and probability.
So let's start with the one that's always working against the option buyer: time. What exactly is Theta?
Theta is the silent killer of long option premium. On a technical level, it measures how much value an option is expected to lose each day, assuming all other factors, like the stock price and volatility, remain completely unchanged. For anyone who buys a call or a put, Theta will always be a negative number. It's a guaranteed headwind you're fighting against every single day you hold the position.
So it's a constant drain on the option's value.
Precisely. The easiest way to think about it is like paying rent. When you buy an option, you are buying the right, but not the obligation, to do something for a specific period of time. That time has value, and you are paying for it. Theta is the daily rent that gets deducted from your option's premium. Every day that passes, you've used up one day of that contract's life, and its value decreases accordingly, even if nothing else happens in the market.
And this effect isn't linear, correct? The rent gets more expensive as you get closer to the move-out date.
That's a perfect way to put it. The rate of time decay, or Theta, accelerates dramatically as an option approaches its expiration date. An option with 6 months of life might lose only a few cents of value per day, but an option with only a week left until expiration could lose a significant chunk of its value, say 20 or 30 cents in a single day. This is because the probability of a large, profitable move in the underlying stock diminishes rapidly as the available time shrinks. The market knows that a stock has a much lower chance of moving $5 in one day than it does in 1 month, and the option's time value reflects that reality. The decay curve gets incredibly steep in that final month, and especially in the final week of an option's life.
Which is why holding a long option through its final days can be so treacherous if your expected move hasn't materialized yet. You're fighting a very powerful current.
An incredibly powerful current, and this is particularly true for at-the-money options. They have the most time value or extrinsic value to lose. Deep in the money or far out of the money options are composed mostly of intrinsic value or have very little value to begin with, so their Theta is much lower. But that at-the-money option, the one with the most uncertainty, has the most rent to pay, and thus the highest Theta.
All right, so Theta is the unavoidable cost of time. Let's shift to the other major variable, the one that reflects market emotion, volatility. How does Vega fit into this playbook?
If Theta is the steady, predictable ticking of a clock, Vega is the market's mood ring. It measures an option's sensitivity to changes in implied volatility. Specifically, Vega tells you how much an option's price will change for every 1 percentage point change in the implied volatility of the underlying stock.
So we're not talking about the actual historical volatility of the stock, but the expected or implied future volatility that the market is pricing into the options.
Exactly. Implied volatility, or IV, is a reflection of uncertainty and fear. When the market anticipates a big move, perhaps due to an upcoming earnings report, an FDA announcement, or a major economic data release, demand for options increases. Both buyers and sellers anticipate a larger than normal price swing, so they bid up the price of the options. This increase in option premium, independent of any change in the stock's price, is a rise in implied volatility. Vega quantifies your position's sensitivity to that change.
And unlike Theta, Vega can work for you or against you, depending on your position.
Correct. If you are long an option, a call or a put, you have positive Vega. This means that if implied volatility increases, the value of your option will rise, all else being equal. If IV decreases, your option's value will fall. Conversely, if you are an option seller or short an option, you have negative Vega. You profit when implied volatility falls. Longer-dated options and at-the-money options have the highest Vega, as their prices are most influenced by long-term uncertainty.
Let's make this tangible. Say a stock is trading at $100 and you buy a call option. Suddenly, a rumor hits the market about a potential takeover. The stock itself might only tick up slightly to $101, but what happens to the option?
This is where Vega shines. The stock price itself hasn't moved much, but the uncertainty surrounding the company has skyrocketed. The market is now anticipating a potentially massive price move in the near future. As a result, implied volatility might spike, let's say from 20% to 35%. Because of that 15-point jump in IV, your call option could instantly surge in value, perhaps by 50% or more, even though the underlying stock has barely budged. You're not just profiting from the small directional move, you're profiting from the market's increased fear or greed. Your option is now more valuable because the potential for a huge move has increased.
This leads directly to one of the most important concepts for anyone trading around events, the IV crush.
Yes, the IV crush is the other side of that coin. It's the rapid and often brutal collapse in implied volatility that occurs immediately after a known event has passed. Think about the lead-up to a company's earnings report. In the days and weeks prior, uncertainty is extremely high. No one knows what the numbers will be or how the market will react. This uncertainty inflates implied volatility, making the options very expensive.
You're paying a premium for the right to play the earnings lottery.
Precisely. But the moment the earnings are released, that specific uncertainty vanishes. It's gone. The news is out. The mystery is solved. Regardless of whether the stock goes up, down, or sideways, the future is now much less uncertain than it was a minute before the announcement. This resolution of uncertainty causes implied volatility to crush.
And what does that do to the option prices?
It can be devastating for an option buyer. You could correctly predict the direction of the stock's move, but still lose money. For example, you buy a call option expecting great earnings. The company reports fantastic results, and the stock jumps up 5%. You think you've made a killing. But when you look at your options price, you find it's actually down 20%. Why? Because the pre-earnings IV was, say, 100%, and after the announcement, it crushed back down to its normal level of 30%. The positive impact of your delta was completely overwhelmed by the negative impact of the massive drop in Vega. The air was let out of the balloon.
This really highlights the fact that buying options right before earnings is not a simple directional bet. It's a bet that the stock will move more than the elevated IV is already pricing in.
That is the absolute key. You are not betting on direction. You are betting on the magnitude of the move relative to the market's expectation. Research from platforms like tastytrade has shown repeatedly that over the long run, implied volatility tends to overstate the actual move that occurs. The market consistently prices in more fear than what ultimately materializes. This statistical edge is the foundational principle behind selling premium, especially in high IV environments.
So, from a strategic standpoint, a trader should be constantly aware of the level of implied volatility.
When it's high, it might be a better environment to be an option seller, and when it's low, a better time to be a buyer?
That's the general playbook. When IV is high, options are expensive. The rent you pay, Theta, is higher, but the potential reward for selling that premium is also greater, as you can profit from both time decay and a potential IV crush. You are selling expensive insurance. When IV is historically low, options are cheap. Your potential loss from Theta is smaller, and you have positive Vega, meaning you could benefit not only from a directional move, but also from a reversion to the mean, a rise in volatility back to its normal levels. You are buying cheap lottery tickets.
So it's about putting the probabilities in your favor. You have Theta, the steady decay, and Vega, the measure of fear. How do you summarize the interplay between these two powerful forces?
I think it comes down to this. Every option position you hold is a race between your thesis playing out and the value of your option decaying over time. Theta is the clock that is always ticking against the option buyer. It's the cost of being in the game. Vega is the wild card. It's the market's sentiment that can either supercharge your gains or decimate them overnight. To succeed, you must be acutely aware of both. You need to know how much time you're paying for and whether the market's fear, as reflected in implied volatility, is working for you or against you.
A fantastic summary. So the key takeaway for our listeners is that you can't just focus on the stock's price. Theta eats away at your option's value with every passing day, a force that accelerates as you near expiration. Meanwhile, Vega dictates how sensitive your option is to the market's collective fear and uncertainty.
That's right. Always watch the clock and always watch the IV. In the world of options, time and fear are just as important as price and direction. Understanding them is what separates a simple bet from a calculated strategy. High IV tends to favor sellers of premium, while low IV can present opportunities for buyers. Managing your exposure to both is fundamental to playing the game well.
Welcome back to the Options Playbook. In our last session, we dissected two of the most critical Greeks: Theta, the relentless ticking clock of time decay, and Vega, the measure of an option's sensitivity to market fear. We established that as traders, we are constantly navigating the currents of time and volatility. But saying an option is sensitive to volatility is one thing. Truly understanding what that volatility is and how to measure its temperature is another beast entirely.
Exactly. It's the difference between knowing the weather affects your travel plans and being a meteorologist who can read the atmospheric pressure, humidity, and jet stream. Today, we're becoming the meteorologists of the options market. We're going to tackle a question that puzzles many traders. You see two different stocks, both trading at exactly $100 per share, yet an at-the-money call option on one costs $5, while the same option on the other costs a whopping $10. The price of the underlying is identical. So what accounts for that massive difference in the options price?
The answer, of course, is volatility. But that word itself is too simple. It's a blanket term covering a complex landscape. So today, we're taking out our topographical map and diving deep. We'll first distinguish between the two fundamental types of volatility: historical versus implied. Then we'll learn how to contextualize current volatility using powerful tools like implied volatility rank and percentile. And finally, we'll explore the curious phenomenon of volatility skew, which explains why not all options on the same underlying are priced with the same level of fear.
These aren't just academic concepts. They are the bedrock of strategic decision-making in options trading. Understanding this landscape is what separates guessing from educated positioning. It's how we determine if the insurance premium we are either buying or selling is cheap or expensive relative to history, which directly informs whether we should be deploying buying strategies or selling strategies. It builds directly on our understanding of Vega by giving us the tools to quantify and qualify the very volatility that Vega measures.
Let's start with that foundational distinction, historical versus implied volatility. When we talk about a stock being volatile, we're usually thinking about its past behavior. How would we formalize that?
That's the perfect starting point. The concept you're describing is historical volatility, or HV. You can also hear it called realized or statistical volatility. In simple terms, it's a backward-looking measure. It tells you how much a stock's price has actually fluctuated on a day-to-day basis over a specific past period, say the last 30, 60, or 90 days. Statistically, it's the annualized standard deviation of the stock's daily price changes. It is a fact. It is what has happened.
So, if we say a stock has a historical volatility of 25%, we're saying that over the past year, its price has tended to move within a range that corresponds to that statistical measure. It's a report on its past character. But option prices aren't based on what happened in the past. They are bets on the future.
Precisely. And that brings us to the other side of the coin, implied volatility, or IV. This is the big one for options traders. Implied volatility is the market's collective forecast of how volatile the stock is expected to be in the future, specifically between now and the option's expiration date. It's not calculated from past price movements. Instead, it is the volatility figure that, when plugged into an option pricing model like Black-Scholes, yields the current market price of the option. It is, in essence, the volatility that is implied by the option's price.
So HV is the documented past, and IV is the market's prophecy for the future. One is a historical record, the other is a collective opinion embedded in a price.
That's the perfect way to frame it. Think of it like planning a cross-country road trip in July. Historical volatility is like looking at the weather data for the route from last July. You can see the average temperatures, the number of sunny days, the amount of rainfall. It's useful, factual data. Implied volatility, on the other hand, is the current weather forecast for your specific travel dates. The forecast might predict a massive, unexpected heat wave or a series of severe thunderstorms. This forecast, this expectation of future conditions, is what will determine the cost of your travel insurance. Option premiums are the same. A company with a major earnings report coming up will have a very stormy forecast, high implied volatility, and its options, its insurance, will be priced accordingly, regardless of how calm its stock has been over the past month.
That makes sense. The market is pricing in a potential future event. But this leads to a critical question for a trader. If the implied volatility for a stock is, say, 40%, how do I know if that's high or low? 40% might be a normal Tuesday for a biotech stock, but an apocalyptic event for a utility company. We need a way to contextualize that number.
You've hit on the most practical challenge. A raw IV number in isolation is almost meaningless. This is where we introduce the concepts of IV rank and IV percentile. These are tools designed to answer one simple question: is the current implied volatility high or low for this specific stock relative to its own history? They put the current IV in context.
Let's break those down. What is IV rank telling us?
IV rank, or implied volatility rank, takes the current IV and places it on a scale from 0 to 100 based on the lowest and highest IV levels that stock has seen over a defined look-back period, typically 1 year. The formula is current IV minus 52-week low IV divided by 52-week high IV minus 52-week low IV. So an IV rank of 100 means the current IV is the absolute highest it's been all year. An IV rank of 0 means it's at its absolute low. An IV rank of 50 means it's exactly in the middle of its 52-week range.
So if a stock's IV has ranged from 20% to 60% over the last year, and today it's sitting at 40%, it would have an IV rank of 50. It's right in the middle of its typical range.
Exactly. It's a quick and powerful gauge of whether options are expensive or cheap on a relative basis. Traders who focus on selling premium, for instance, typically look for stocks with a high IV rank, say above 50 or 60. Their thesis is that volatility is mean reverting. When it's at the highest end of its annual range, it's more likely to fall than to keep rising. By selling an option in that high IV environment, they collect a large premium and are positioned to profit if and when that IV crushes or reverts back toward its average.
And what about IV percentile? It sounds similar, but there must be a subtle difference.
There is, and it's an important one. While IV rank tells you where we are within the range of highs and lows, IV percentile tells you what percentage of days over the past year the stock's IV has closed below the current level. So an IV percentile of 85% means that on 85% of the trading days in the last year, the IV was lower than it is right now. It gives you a sense of frequency. Generally, they move in a similar direction, but IV percentile can be a bit more robust because it isn't skewed by a single extreme outlier day of high or low IV during the year. For most strategic purposes, though, traders use IV rank as the primary tool.
This brings to mind a critical market tendency that we've touched on before. The idea that implied volatility often overstates the subsequent realized move. The forecast is often more dramatic than the actual weather.
This is the secret sauce for many professional options sellers. Extensive research, notably from platforms like tastytrade, has shown that on average and over time, implied volatility tends to be higher than the historical volatility that ultimately materializes. Why? Because IV is driven by fear and uncertainty. The market tends to price in the worst-case scenario. When there's a big binary event like an earnings announcement, the IV might spike to 80 or 100%, pricing in a massive potential move. More often than not, the actual move is less extreme than what the options were priced for.
This is the IV crush we discussed in the last episode in the context of Vega. After the earnings news is out, uncertainty evaporates and IV collapses back toward its baseline.
Precisely. Let's use a concrete example. Suppose a stock's typical IV is around 25%. In the week before earnings, fear and speculation drives the IV up to 60%. It now has an IV rank of, say, 95. A premium seller sees this and recognizes that options are historically very expensive. They might sell a straddle or a strangle, collecting a very rich premium. The earnings are released, the stock moves, but the uncertainty is gone. The next day, the IV plummets back down to 30%. Because of that massive drop in IV, that crush, the value of the options they sold has decreased significantly, often leading to a profit for the seller, even if they were slightly wrong on the direction of the stock's move. They bet on the statistical tendency of the forecast to be overly dramatic.
So, the trading rule of thumb becomes, in high IV rank environments, look for opportunities to sell premium. In low IV rank environments, options are relatively cheap, making it a more favorable time to be a buyer of options, like purchasing a call or a put.
That is the core strategic framework. You're using IV rank to decide whether you want to be in the business of selling insurance or buying it.
Okay, we've covered the difference between past and future volatility and how to measure if the future forecast is high or low. But there's one more layer of complexity. If we look at an option chain, we often see that different strike prices for the same expiration date have different implied volatilities. How can that be?
This brings us to our final concept, volatility skew, sometimes called the volatility smirk. It's the observation that on a single underlying for a single expiration, the implied volatility is not flat across all strike prices. For most equity and index options, if you were to plot the IV for each strike price, you wouldn't see a flat line. You'd see a shape that often looks like a smirk or a skewed smile.
And what does that smirk tell us?
Specifically, for equity markets, the smirk is typically downward sloping to the right. This means that out-of-the-money puts, the strikes far below the current stock price, have a significantly higher implied volatility than at-the-money options or out-of-the-money calls.
So the options that pay off if the market crashes have a higher implied fear level priced into them.
Exactly. It boils down to one word, fear, or more technically, risk aversion. The market has a long memory of crashes. Stocks tend to fall much faster than they rise. They take the stairs up and the elevator down. Because of this, institutional players and individual investors are constantly seeking to hedge their portfolios against a sudden sharp downturn. They do this by buying out-of-the-money puts, which act as portfolio insurance. This persistent, high demand for downside protection inflates the price of those OTM puts. And since IV is backed out from the option's price, a higher price results in a higher IV. The The skew is the literal graphical representation of the market's collective fear of a crash.
So the skew is a direct reflection of supply and demand for insurance. The demand for crash insurance via OTM puts is perpetually higher than the demand for fear of missing out insurance via OTM calls, so the puts carry a higher IV premium.
That's a perfect summary. It's a structural feature of the market, and understanding it helps you better appreciate the nuances of option pricing. It tells you that the market is not pricing probabilities symmetrically. It's always looking over its shoulder for a potential drop.
Let's tie it all together. We started by differentiating historical fact from implied forecast. Then we learned to use IV rank to determine if that forecast is extreme or subdued. And now we see with skew that this forecast isn't even uniform, carrying a bias of fear toward the downside. It's a rich, dynamic picture.
It really is. And mastering it is what elevates a trader's game. You don't just look at an option's price anymore. You see the story behind it. You see the market's fear, its expectations, and its biases, all encoded in these volatility metrics. Volatility truly is the secret sauce in options pricing. Your playbook should be guided by it. Use implied volatility and IV rank to pick your strategy's core bias. Buy options when IV is unusually low and the insurance is cheap, and look to sell options when IV is unusually high and the insurance is expensive, always remembering that the market's forecast, implied volatility, often shrinks back to the reality of what actually happens.
Welcome back to the Options Playbook, where we move from the timeless principles of options theory to the frantic, high-speed reality of today's market. Last time, we unpacked volatility, the secret sauce in options pricing. We talked about how implied volatility is the market's forecast, its collective guess about the future. But what happens when that future is no longer weeks or months away, but a matter of hours or even minutes? How does our playbook adapt when the game is suddenly being played at the speed of light?
That's the critical question. Today, we're diving headfirst into the dynamics that define the modern market. We'll explore the explosive world of zero-day to expiration options, or zero DTEs, and dissect why they've become so popular. We'll also pull back the curtain on the high-frequency and algorithmic trading that dominates this space. Finally, we'll distinguish between the very different use cases, using these tools for precise, tactical hedging versus chasing speculative, lottery ticket-style profits.
Exactly. Understanding volatility was foundational. Now we're applying that knowledge to an environment where volatility can be compressed into a single trading session. It's about understanding not just the what of the options, but the who and how of the market they trade in. The game has changed, and the speed itself has become a factor we have to price in.
Let's start with the phenomenon at the heart of this shift, the zero DTE option. These are simply options contracts, calls, or puts that are set to expire at the close of trading on the very day you are trading them. So if it's Monday morning, you can trade an option on an index like the S&P 500 that will cease to exist after 4 p.m. Eastern Time that same day.
It's an incredibly compressed time frame. The entire life of the trade, from entry to exit or expiration, happens within hours. This isn't your traditional 30 or 60-day option, and their growth has been nothing short of meteoric.
Absolutely explosive. To put it in perspective, by May of 2025, trading in zero DTE options on the SPX index accounted for a staggering 61% of the total daily volume. Think about that. The majority of options volume on the world's most watched index is now in contracts that will be worthless by the end of the day. This isn't a niche product anymore. It's becoming a central feature of market structure.
So why the massive surge in popularity? On the surface, the appeal is obvious. It's the allure of a very fast, potentially very high leverage payoff. You can place a bet on the market for the day, and if you're right, the returns can be astronomical. The cost of entry is often very low, so it feels like a low-risk, high-reward proposition.
It feels that way, but the reality is quite different. It's more like a low-probability, high-cost proposition. The risks are substantial, and they often get glossed over in the excitement of rapid gains. One of the biggest and most insidious is the transaction cost. We're not just talking about commissions. We're talking about the bid-ask spread, the slippage you get when you try to enter and exit these fast-moving instruments.
And the data on this is really quite sobering. A major study conducted in 2024 looked at the performance of retail traders in the zero DTE space. It found that a jaw-dropping 70% of the total losses incurred by these traders were eaten up by transaction costs alone. Let me repeat that. 70% of their losses weren't from bad directional bets, but from the costs associated with making the trades in the first place.
It's a critical point. It means even if your thesis is correct, say you correctly predict a small upward drift in the market, the cost of getting in and out of the trade can easily erase any profit you might have made. You have to be right, and you have to be right by a large enough margin to overcome the friction of the trade itself.
This high-cost environment is amplified by the other major players in this space, high-frequency trading firms and their algorithms. We're not just trading against other individual investors. We're trading against machines that can process information and execute trades in microseconds.
That's right. These algorithmic systems are designed to do one thing: capitalize on tiny, fleeting pricing imperfections and order flow imbalances. They see your buy order hitting the market and can react to it, adjusting prices across thousands of strikes and multiple exchanges before a human trader can even click their mouse a second time. This creates an environment of extreme price sensitivity and unpredictability, especially around key news events or economic data releases. The price you see on your screen might not be the price you can actually trade at a moment later.
So the very structure of the market is almost purpose-built to be difficult for a manual retail trader. You're slower, you're paying higher proportional costs, and your orders are providing the very liquidity and information that these sophisticated algorithms are designed to exploit.
It's like trying to play a game of speed chess against a supercomputer. The computer doesn't need to be smarter in a grand strategic sense. It just needs to be faster and more precise on a move-by-move basis. To make this more concrete, think of traditional options trading, with expirations weeks or months out, as a game of deep-sea fishing. You do your research, you study the weather patterns, the market volatility, you pick your spot, cast your line, and you wait. It requires patience, strategy, and an understanding of the broader environment. There's still risk, but you have time to manage your position, to react to changing currents.
I like that analogy. It's a strategic, patient endeavor.
Now, imagine zero DTE trading. This isn't deep-sea fishing. This is trying to catch a specific fish with your bare hands in a churning, violent river surrounded by a dozen grizzly bears who are faster and better at it than you are. The water is murky with rapid price movements. The grizzly bears are the high-frequency trading firms, grabbing every fish, every bit of profit the moment it appears. And every time you even try to lunge for a fish, you have to pay a toll, which is your transaction cost. You might occasionally get lucky and snag one, but most of the time you'll end up wet, empty-handed, and a little bit poorer for the effort.
And the bears always get fed. That really paints a picture of the structural disadvantages at play. However, despite this environment, there are legitimate strategic uses for these instruments, aren't there? It's not all just speculation.
Correct. The key is to use them for what they're good at: extremely short-term, event-based hedging. They can function as a form of highly targeted insurance. Imagine it's 1:55 p.m. and the Federal Reserve is about to announce its interest rate decision at 2 p.m.
You hold a large portfolio of stocks and you're worried about a sharp negative market reaction.
You don't necessarily want to sell your long-term holdings, but you want to protect yourself over the next 30 minutes of extreme uncertainty.
Exactly. In that scenario, you could buy zero DTE puts on the SPX. They would be relatively cheap because their time value is almost zero. You're essentially just buying pure, immediate downside protection. If the market tanks after the announcement, your puts will spike in value, offsetting some of the losses in your main portfolio. If the market rallies or does nothing, the puts expire worthless. Your loss is small, and most importantly, it's strictly defined. You paid a small premium for peace of mind during a specific high-risk event.
So it's used as a tactical tool, not a primary strategy for generating profit. You're accepting the cost of the option as the cost of insurance for a very specific, known period of risk.
That's the strategic use case. The problem is that this is not how the majority of retail volume in zero DTEs is being deployed. The far more common use is pure speculation, treating these options less like insurance and more like lottery tickets. A trader might see the market trending up and buy a slightly out-of-the-money zero DTE call for just a few pennies, hoping for a sharp afternoon rally that turns that small bet into a massive payout.
And while that can happen, the probability is incredibly low. You're betting on a significant move in your favor within a very short window, and you still have to overcome the bid-ask spread and commissions to come out ahead. It becomes a series of low-probability bets where the constant drain of transaction costs creates a powerful headwind against your long-term success.
It's a game of asymmetric information and speed that individuals are simply not equipped to win consistently. The market makers and high-frequency firms who sell these options are playing a different game. They're not betting on direction, they are managing a massive, diversified portfolio of these short-dated options, profiting from the statistical decay of time value and the bid-ask spread, scalping pennies thousands of times a minute. They are the casino, and the speculative zero DTE buyer is the gambler pulling the slot machine lever. So as we bring this all together, it's clear the options market has fundamentally evolved. The introduction and popularization of these one-day options, coupled with the dominance of high-speed algorithmic trading, has created a new hyper-fast arena. And while these zero DTE instruments offer the benefit of a clearly defined risk, you can only lose the premium you paid, they operate in a domain of razor-thin margins, high costs, and unpredictable intraday moves.
That's the essential takeaway. This isn't an argument to ignore their existence. They are now a permanent part of the market landscape, but they must be approached with a full and sober understanding of the environment. For the vast majority of investors and traders, these are not strategic wealth-building tools. They are highly speculative instruments, best used, if at all, for very specific tactical hedging purposes. For all others, the churning river is best observed from the safety of the bank.
Welcome back to the Options Playbook, where we move from theory to practice. In our last discussion, we explored the new high-speed landscape of the modern market, the world of zero-day to expiration options, and the influence of high-frequency trading. We looked at the extreme short-term dynamics, the how and why the market moves so fast.
Exactly. We examined the structure of the game board. Today, we start placing our pieces. We're kicking off a multi-part series on core strategies, the foundational plays that every options trader needs to understand. We'll begin with the most direct and intuitive strategies of all, the long call and the long put. These are the tools you use when you have a strong conviction about a stock's direction.
It's the classic question. What if you believe a stock is about to soar, or conversely, plummet? How can you structure a trade that offers explosive, leveraged returns if you're right, but caps your potential loss if you're wrong? That's the puzzle we're tackling today. We'll deconstruct the mechanics of buying calls for upside exposure and buying puts for downside bets.
And crucially, we'll anchor this in the mathematics of expectation and probability. It's one thing to understand the payoff diagram, but it's another to grasp the statistical realities of these trades. So we'll explore why these seemingly simple bets are often a high-wire act, balancing immense potential with a very real chance of losing your entire investment. This understanding is the bridge between gambling and strategic trading.
A perfect place to start. Let's begin with the bullish side. Imagine a trader is incredibly optimistic about a company's upcoming earnings report. They don't just think the stock will go up, they think it will launch. How does a long call option serve that thesis?
The long call is the purest expression of bullishness in the options world. When you buy a call option, you are purchasing the right, but not the obligation, to buy 100 shares of the underlying stock at a predetermined price, which we call the strike price, on or before a specific expiration date. Your entire risk is the amount you pay for that right, the premium.
So the loss is strictly defined from the outset. You know the absolute maximum you can lose the moment you enter the trade. But what about the other side of that equation, the potential gain?
That's where the power of leverage comes into play. The potential profit on a long call is, in theory, unlimited. A stock's price can rise indefinitely, and as it does, the value of your call option increases along with it, often at a much faster percentage rate than the stock itself. You're controlling 100 shares of stock for a fraction of the cost of actually buying them.
This is where it gets interesting for traders looking for outsized returns. Let's make this tangible with an example. Walk us through a hypothetical trade.
Let's imagine a fictional company, Acme Corporation, currently trading at $100 per share. You've done your research and you believe a new product launch is going to send the stock significantly higher within the next month. You could buy the shares for $100 each, but you want more leverage and a defined risk. So you look at the options chain. You decide to buy a call option with a strike price of $105 that expires in 30 days. The price for this option, the premium, is $2 per share. Since one contract represents 100 shares, your total cost and maximum risk for this one contract is $200.
Okay, so you've paid $200 for the right to buy 100 shares of Acme at 105. Your break-even point on the stock price at expiration would be the strike price plus the premium paid, so 107. The stock needs to move past 107 for the trade to be profitable. Now, let's play out two scenarios. First, the explosive move you predicted happens.
Exactly. Let's say the product launch is a massive success, and just before your option expires, Acme's stock shoots up to $120 per share. Your 105 strike call option now has an intrinsic value of $15 per share. That's the 120 stock price minus the 105 strike price. Since your initial cost was $2, your net profit is $13 per share, or $1,300 on your initial $200 investment. That's a 650% return. To achieve a similar dollar profit by owning the stock, you would have had to invest $6,500 to buy 100 shares at 100, which would have yielded a profit of $2,000, or just over a 30% return. The leverage is immense.
A 650% return versus a 30% return. That starkly illustrates the appeal. But it also highlights the dependency on a large move. What happens in the second scenario, where you're right about the direction but not the magnitude? Let's say Acme stock only rises to $103 by expiration.
This is the harsh reality of buying options and the critical lesson for every trader. If the stock is at $103 at expiration, your right to buy it at $105 is worthless. Nobody would exercise an option to buy a stock for $105 when they can buy it on the open market for $103. The option expires, and your entire $200 premium is lost. It's a 100% loss. This is the crux of the strategy. You can be correct on the direction, but if the stock doesn't move enough to surpass your break-even price, you lose everything you invested.
That's a powerful lesson. It's not just about being right, it's about being right enough. The stock has to cover the cost of the premium for you to even get back to zero. Now let's flip the coin. What if your analysis leads you to a deeply bearish conclusion? How does the long put work?
The long put is the mirror image of the long call. It's a direct bet on a stock's price falling significantly. When you buy a put option, you are purchasing the right, but not the obligation, to sell 100 shares of stock at the strike price on or before expiration. Just like the long call, your maximum loss is capped at the premium you paid.
And the profit potential? While a stock can't go below zero, a substantial drop can still lead to significant gains.
Precisely. Let's use our Acme example again, which is still trading at $100. This time, you expect a terrible earnings report. You buy a put option with a 95 strike price, also for a $2 premium, costing you $200. Your break-even price is now $93, the strike price minus the premium. If Acme stock crashes to $80, your put option is now worth $15 per share, 95 strike price minus the $80 stock price. Your net profit is $13 per share or $1,300, the same 650% return as our winning call example.
And the downside is, again, the same risk of a total loss. If the stock stays above 95 or even just drips down to 96, the option expires worthless and the $200 premium is gone.
Correct. The mechanics are symmetrical. Both strategies are low-probability, high-potential reward propositions. You are trading a high probability of a small 100% loss for a small probability of a very large gain. It feels a bit like buying a lottery ticket with slightly better calculable odds.
This brings us to the core mathematical underpinning you mentioned earlier, expected value and probability. The 10-bagger potential is seductive, but what do the numbers say about how often these trades actually work out?
This is where many new traders get into trouble. They fixate on the unlimited or massive upside and forget to price in the probability of that event occurring. For an out-of-the-money option, like the 105 call we bought when the stock was at 100, the market is telling you there is a low probability of the stock reaching that price before expiration. That's why the option is relatively cheap. Analysis from probability-based trading educators often shows that a simple long call or put may only have around a 30 to 40% chance of being profitable at all. And the chance of a massive win is even smaller.
So even getting to break even can be a coin flip or worse. This implies that consistently buying naked calls and puts is a statistically difficult way to make money over the long term.
It is. This is why many experienced traders rarely use this as their primary strategy. They often prefer to build spreads, buying one option and selling another to finance the purchase and improve their probability of profit. We will definitely dedicate future episodes to those more advanced structures. However, that doesn't mean the long call and put have no place. They are a tool for a very specific purpose.
Which is what? If the odds are stacked against you, why use them at all?
They are used for high-conviction, speculative plays where you anticipate significant, rapid movement. Think of events like a make-or-break FDA announcement for a biotech company or a pivotal earnings release. In these binary event scenarios, the stock isn't likely to move a little, it's likely to move a lot one way or the other. The key is position sizing. Because they are low probability bets, they should be made with a small amount of capital that you are fully prepared to lose. You are risking a little for the chance to gain a lot.
So it's a calculated risk on a high-impact event, not a core portfolio strategy. It's a tactical play, not a strategic foundation.
Absolutely. Think of it as a sniper rifle, not a machine gun. It's a precise tool for a specific, well-defined target. You don't use it all the time, but when the conditions are perfect, it can be incredibly effective. The danger is when traders start using it for every situation, hoping every stock will have that explosive move. Most of the time, they don't, and the options decay to zero.
This seems to be the critical takeaway then. The long call and long put are the simplest ways to get leveraged directional exposure. Your risk is strictly defined by the premium you pay, which is the most you can ever lose.
Yes, but that leverage cuts both ways. The potential for outsized gains is counterbalanced by the high probability of a 100% loss. These are not set-it-and-forget-it strategies. They require you to be right about direction, magnitude, and timing. If any of those three variables are wrong, the trade is likely to fail. Use them, but use them sparingly and use them small.
Welcome back to the Options Playbook. In our last session, we explored the high-leverage world of buying calls and puts, strategies designed to capture explosive directional moves. It was all about paying a premium for a small chance at a massive 10-bagger return. But what if your goal isn't to hit a home run? What if you're looking for consistent singles and doubles?
What if instead of paying for the right to do something, you wanted to get paid for taking on an obligation? This shifts the entire dynamic. We move from speculating on direction to generating an income stream. It's a completely different mindset, one that focuses on probability and time decay rather than pure price momentum.
Exactly. It's a playbook for a different kind of game.
Today, we're going to break down two of the most fundamental income strategies in the options world. First, the covered call, a method for generating yield from stocks you already own. And second, the cash-secured put, a technique that essentially pays you to buy a stock you want, but at a lower price.
These two strategies are really two sides of the same coin. They represent a foundational shift from being an option buyer, where time is your enemy, to an option seller, where time decay becomes your best friend. Understanding this transition is crucial for any trader looking to build a more robust and versatile portfolio.
Let's start with the one most long-term investors can immediately relate to, the covered call. Imagine you own 100 shares of a company, XYZ, which you bought at $100 per share. You believe in the company long-term, but you don't expect it to skyrocket in the next month. Right now, those shares are just sitting there. They only make you money if the stock price appreciates.
And in a flat or slightly rising market, that can feel unproductive. The covered call strategy allows you to put those otherwise idle shares to work. The mechanics are simple. Because you own 100 shares of the underlying stock, you have the right to sell one call option against that position. That option is considered covered because you already own the shares you might be obligated to deliver.
So when you sell that call option, you immediately receive a cash payment, the premium, deposited directly into your account. This is your income for the trade. Now, two primary outcomes can unfold by the option's expiration date.
The first, and often the desired outcome, is that the stock price remains below the strike price of the call you sold. If that happens, the option expires worthless. The buyer won't exercise it. You keep the entire premium you collected, and, importantly, you also keep your 100 shares of stock. You've successfully generated income from your holdings without having to sell them.
And the second outcome?
The second outcome is that the stock price rises above the strike price. In this case, your shares will be called away. You'll be obligated to sell your 100 shares at the agreed-upon strike price. You still keep the premium, but you miss out on any potential gains above that strike. You've realized a profit, but your upside was capped.
I think an analogy would be helpful here. It feels like you're making a trade-off between immediate income and future potential.
It's very much like being a landlord. Imagine your 100 shares are a house that you own outright. Selling a covered call is like renting that house out for a month. You receive rental income, the option premium, up front. If the housing market stays flat or goes down a little, you're happy. You kept the house and you collected rent, which helps offset your costs or access pure profit.
But what if the housing market suddenly booms?
That's the trade-off. Your rental agreement might have given the tenant an option to buy the house from you at a pre-agreed price, the strike price. If real estate values soar past that price, the tenant will exercise their option. You're forced to sell. You've made a tidy, defined profit, but you watched your neighbors sell their identical houses for much more. You've capped your potential gain in exchange for that guaranteed rental income.
That clarifies the risk-reward profile perfectly. Let's apply some hard numbers. We own 100 shares of XYZ at $100. Let's say we sell a call option with a strike price of $110 that expires in 30 days, and for that, we collect a premium of $3 per share, or $300 in total.
Right. That $300 is yours to keep, no matter what happens next. Now, let's look at the scenarios at expiration. First, imagine XYZ closes at 108. The 110 call is out of the money and expires worthless. You keep your $300 premium, and you still own your 100 shares, which have also appreciated by $8 each. It's the best of both worlds.
What's important here is that the $3 premium also provides a downside cushion. Since we bought the stock at $100, our actual break-even price on the entire position is now $97. The stock could fall by $3, and the premium we collected would cover that loss.
An excellent point. Now for the other scenario. Let's say the stock has a great month and shoots up to 120. Your $110 call is now deep in the money. You will be assigned, and you have to sell your 100 shares for $110 each. Your total profit is the $10 of capital appreciation per share plus the $3 premium per share you collected up front. That's a $13 per share profit, or $1,300.
It's a good outcome, but you did miss out on that extra $10 of upside between 110 and 120.
So the covered call is an income strategy for stocks you're neutral to mildly bullish on. You're willing to sacrifice some potential upside in exchange for immediate cash flow and a bit of downside protection. Now let's pivot. What if you don't own the stock, but you want to?
This brings us to the cash-secured put, which is a brilliant strategy for patient investors. It's a way to get paid while you wait for a stock to come down to a price you're comfortable paying. The premise is that you sell a put option on a stock you are genuinely willing to own.
And it's called cash secured because you must have enough cash in your account to buy 100 shares at the strike price if you're assigned. You're collateralizing the trade.
Exactly. Your brokerage will set aside those funds. So let's go back to our XYZ stock, currently trading at $100. You like the company, but you'd love to buy it at $95. Instead of just placing a limit order at $95 and weighing, you could sell a put option with a $95 strike price and, for example, collect a $2 premium. That's $200 of instant income.
So again, there are two potential outcomes at expiration.
Correct. First, if XYZ stays above the $95 strike price, the put option expires worthless. You never have to buy the stock, you simply keep the $200 premium. Your secured cash is freed up, and you've just generated a return on cash that was otherwise sitting idle. You can then repeat the process if you still want to buy the stock.
It's like being paid to be patient. But what happens if the stock does fall? Let's say it drops to $90.
Now you get assigned. You are obligated to fulfill your end of the contract, which is to buy 100 shares of XYZ at the strike price of $95. This costs you $9,500. However, remember that you already received a $200 premium, so your effective purchase price, your cost basis, isn't $95 a share, it's $93. You were able to acquire the stock you wanted, but at a discount to the price you were already willing to pay.
The risk, of course, is that the stock falls much further. If XYZ plummets to $70, you still have to buy it at $95 for that effective cost of $93. You'd be sitting on a significant unrealized loss just as if you had bought the stock at $93 outright.
And that is the most critical rule of this strategy. Never, ever sell a cash-secured put on a company you don't truly want to own for the long term. The goal isn't just to collect the premium. The goal is to either collect the premium as income or to acquire a great company at a discount. Getting assigned shouldn't be seen as a failure. It should be seen as the successful execution of your plan to buy the stock.
So to synthesize this, both strategies are fundamentally about selling options to collect premium. They thrive in neutral, sideways, or gently trending markets. They are not strategies for high-growth, high-momentum environments.
That's the perfect way to put it. You are taking on an obligation in exchange for income. With a covered call, you accept the obligation to perhaps sell a stock you own. With a cash-secured put, you accept the obligation to perhaps buy a stock you want. You are selling someone else the right to make a decision, and they are paying you for that privilege.
Let's summarize with the key takeaways for today's playbook. Covered calls and cash-secured puts are premier strategies for turning your portfolio into an income-generating machine.
With a covered call, you sell a call against shares you already own. It generates immediate income and provides a small downside buffer, but it comes at the cost of capping your potential upside if the stock rallies hard.
And with a cash-secured put, you sell a put on a stock you want to own, secured by the cash to buy it. You either keep the premium as pure income if the stock stays up, or you acquire the stock at an effective price below the strike if the stock goes down.
The ultimate lesson is that you must be comfortable with both potential outcomes. Be willing to sell your shares at the strike price for a covered call, and be genuinely happy to own the shares at your effective cost basis for a cash-secured put. If you can embrace that mindset, you unlock a powerful and consistent way to enhance your returns.
Welcome back to the Options Playbook. We are your hosts, Ben
And Grace.
In our last session, we explored how to generate an income stream from stocks you already own, essentially turning your portfolio into a source of regular cash flow through covered calls and cash-secured puts.
Exactly. We focused on strategies where you are the seller of the option, collecting a premium upfront. But that raises a critical question. What happens when the market feels uncertain? What if you're happy with your stock holding, you've seen some great gains, but you're becoming more concerned with protecting your downside than with generating a small incremental income? How do you shield your portfolio from a potential drop?
That's the crucial other side of the coin. It's not just about offense. A complete strategy must include defense. Today, we're adding two powerful defensive plays to our playbook, the protective put and the collar. We'll break down how to use options not just for income, but as a form of portfolio insurance.
We'll look at how buying a simple put option can establish a hard floor for your potential losses on a stock. And then we'll build on that by exploring how you can use the income-generating strategies we've already discussed to pay for that protection, creating a structure that locks in a specific range of outcomes for your investment. This is about moving from pure speculation or income generation to active risk management.
Think of it this way. Last time, we were the insurance company, selling policies and collecting premiums. Today, we are going to be the consumer, buying insurance to protect a valuable asset. The first and most direct way to do this is with a protective put.
And I've also heard this referred to as a married put, presumably because you execute both trades, buying the stock and buying the put, at or near the same time.
That's right. The structure is simple. For every 100 shares of stock you own, you buy one put option. This strategy is a direct hedge. The goal isn't necessarily to profit from the option itself, but to have the option profit in a scenario where your primary holding, the stock, is losing value. It establishes a minimum selling price for your stock for as long as that put option is active. Your downside risk becomes strictly defined and limited.
So, if I own a stock trading at $150 and I'm worried it could fall significantly, I could buy a put with a strike price of, say, $140. If the stock then plummets to $100, my put option gives me the right to sell my shares at $140, effectively stopping my losses at that level.
Precisely. Your maximum loss is capped at the difference between your stock's price and the put strike price, plus the cost of the put option itself. The upside, and this is key, remains theoretically unlimited, minus that premium you paid. It's genuine insurance. You pay a premium, and in return, you get peace of mind knowing your absolute worst-case scenario is quantified and contained.
The trade-off, then, is the cost. Just like any insurance policy, the premium is a recurring expense. If the stock moves up, or even just stays flat, that premium you paid for the put is a drag on your overall returns. You're sacrificing a small amount of guaranteed profit in exchange for protection against a large, uncertain loss.
That is the perfect way to frame it. Let's make it concrete with an example. Suppose you own 100 shares of company XYZ, which is currently trading at $100 per share. You've had a good run, but you're getting nervous about an upcoming earnings report or broader market volatility. You want to stay in the stock because you believe in its long-term potential, but you want to protect against a short-term drop below 95.
So, following the logic, you would go out and buy a put option with a 95 strike price.
Correct. Let's say that 95 put costs you $2 per share, or $200 for the one contract that covers your 100 shares. Now, let's play out the scenarios. Scenario 1. The market tanks and XYZ crashes to $80 a share. Your stock position has lost $20 per share, but your put option gives you the right to sell at 95. Your actual loss is only $5 per share on the stock, plus the $2 premium for the put, for a total loss of $7 per share. Without the put, you'd be down $20. You've just saved yourself $1,300.
And the other side of that coin, if the earnings report is fantastic and the stock shoots up to $120, your stock position is up $20 per share. Your $95 put option expires worthless, so you lose the $2 premium you paid for it. Your net gain is $18 per share, or $1,800. You've given up a small piece of the upside, but you've participated fully in the rally otherwise.
It's a straightforward calculation of risk versus reward. You accept a definite, small cost, the premium, to eliminate a potential catastrophic loss. For many investors, especially those nearing retirement or protecting a concentrated position, that certainty is invaluable. But what if you could get that protection for cheaper, or maybe even for free?
This is where we can start weaving together the concepts from our last discussion. The cost of the protective put is the premium you pay out. Last time, we were focused on strategies where you collect premium. It seems logical that you could combine them.
And that is exactly what a collar strategy does. A collar is the combination of a covered call, which we know from last time involves selling a call option against shares you own, with a protective put. You are simultaneously holding the stock, buying a downside put for protection, and selling an upside call to generate income. The goal is often to have the premium you receive from selling the call completely offset the premium you have to pay for buying the put.
So you are capping both ends. You establish a floor below which you cannot lose more, thanks to the put, and you establish a ceiling above which you cannot gain more. Because if the stock price exceeds the strike of the call you sold, your shares will be called away. You're effectively locking your investment into a predefined range.
It's a brilliant structure for a conservative investor who wants to eliminate the costs of hedging. Let's go back to our XYZ stock, owned at $100. We've already established that buying the 95 put costs us $2 per share. Now, to create the collar, let's also sell a call option. We might look at a 105 call and find that we can sell it for a $2 premium.
So the math is quite elegant. You spend $200 on the put contract, but you immediately receive $200 for selling the call contract. Your net cost for establishing this entire protective structure is zero, or very close to it.
Exactly. This is often called a zero-cost collar. Now, what have you done to your position? You still own the stock at $100. You have a guaranteed floor at 95. If the stock falls, you can exercise your put. But you also have a ceiling at 105. If the stock rises above that, your shares will be sold. You have willingly forfeited all potential gains above 105.
The trade-off is now explicit. With the simple protective put, you paid a premium to keep all of your upside potential. With the collar, you've traded away your upside potential beyond the call strike in order to get that downside protection for free. Your outcome is now locked in a range between roughly 95 and 105.
It essentially transforms your volatile stock holding into a more predictable, almost bond-like instrument for a period of time. You know your maximum gain and your maximum loss. This is an incredibly popular strategy for executives with large holdings of company stock, or for any investor who has seen a massive run-up in a position and wants to lock in those gains without necessarily selling the shares and creating a taxable event right away. You're trading certainty for range-bound returns.
And the pricing of that collar, the strike prices you choose for the put and the call, will depend on market conditions, particularly volatility. In a high volatility environment, both call and put premiums will be elevated, so you might be able to buy a put that's closer to the current stock price while selling a call that's further away, widening your potential profit range for a zero net cost.
An excellent point. The implied volatility of the options is a huge factor in how you structure the trade. A collar gives you a defined outcome, which can be immensely valuable in turbulent markets. You're no longer just hoping the stock goes up, you've built a fortress around your position.
So to summarize the core playbook here, if you're a stockholder primarily concerned with a potential sharp decline, the protective put acts as straightforward insurance. You pay a premium, and in return you get a solid floor on your losses while retaining all of your upside.
And if you like the idea of that insurance but are hesitant to pay the premium, the collar is your solution. It lets you finance that protection. You sell away the potential for runaway gains in exchange for that downside safety net, often at little to no out-of-pocket cost. It's about deciding which risk you are more comfortable with, the risk of a market crash or the risk of missing out on a massive rally. These strategies give you the tools to make that choice actively rather than leaving it to chance.
Welcome to the Options Playbook. In our last session, we explored how collars can put a protective fence around our stock positions, defining a clear range for profit and loss. We essentially locked in an outcome.
But what if we wanted to build that defined outcome right from the start, without even owning the underlying stock? What if, instead of going all in on a single directional bet, you could split that bet to precisely define your risk and reward before you even click trade?
That question is really at the heart of today's playbook. We're moving from using options as insurance on a stock we own to constructing a position entirely out of options that has its own built-in risk management. This is a fundamental leap in strategy. We'll be breaking down one of the most essential building blocks in the options world, the vertical spread. Specifically, we're going to diagram the 4 primary variations: the bull-call spread, the bear-put spread, the bear-call spread, and finally, the bull-put spread.
These 4 strategies are the foundation for so many advanced concepts. Understanding them isn't just about adding 4 new plays to your book. It's about learning a new way to think about structuring trades and expressing a market view with precision. It's the difference between simply betting on up or down and betting on up but not more than this, or down but only to this point.
Exactly. Let's start with the name itself. They're called vertical spreads for a very simple reason. When you look at an option chain, the different strike prices for a single expiration date are listed vertically. A vertical spread involves buying and selling options with the same expiration date but different strike prices. That's it. Same month, different strikes. This creates a relationship where the 2 options work together, one offsetting some of the cost and risk of the other.
So it's an inherently hedged position from its creation. Let's get into the first pair, which are known as debit spreads. I assume that means we're paying money to open the position.
Correct. You have a net cash outflow, or a debit, from your account. Let's start with the most common one, the bull-call spread. The name tells you almost everything you need to know. Bull means you want the underlying stock price to go up. Call means you're using call options. And as we just established, spread means you're using more than one. In this strategy, you buy a call with a lower strike price and simultaneously sell a call with a higher strike price, both with the same expiration.
Okay, so you're buying a call that is more expensive and selling a cheaper one to reduce the overall cost.
Precisely. Let's use a tangible example. Imagine stock XYZ is trading at $100 per share. You believe it's going to rise over the next month. You could just buy the 95 strike call for, let's say, $700 or $7 per share. That's your full bet. Your break-even would be $102, the strike price plus the premium you paid. But with a bull call spread, you could buy that same 95 call for $7, and then you might sell the 105 call for $2. Your net cost, your debit, is no longer $7. It's now just $5 or $500 per spread.
That's a significant reduction in cost, but nothing in options is free. What did we give up by selling that 105 call?
We gave up all the potential profit if the stock rockets past 105. By selling that call, you've created an obligation to sell shares at 105 if the price goes above it. This effectively caps your profit. Your maximum gain is the difference between the 2 strike prices minus the net debit you paid to enter the trade. In our example, the difference between the strikes is $10, 105 minus 95. We subtract our $5 net cost, leaving a maximum potential profit of $5 or $500.
So the best case scenario is the stock closes at or above 105 at expiration. At that point, the spread is worth the full $10 between the strikes. We paid $5 for it, so we make $5. And what about the risk?
The beauty of this is that your risk is also perfectly defined. Your maximum possible loss is simply the net debit you pay to put the trade on. If XYZ stock finishes below 95 at expiration, both calls expire worthless. You lose the $500 you pay to enter the position, and not a penny more. You've essentially paid $5 to make $5, and you know your absolute worst-case scenario from the very beginning.
It's a trade-off. You sacrifice the unlimited upside of a simple long call for a lower entry cost, a closer break-even point, and a hard cap on your potential loss. The bearish equivalent, then, must be the bear-put spread.
It's the mirror image. For a bear put spread, you believe the stock is going to go down, so you buy a put with a higher strike price and sell a put with a lower strike price. Again, it's a debit spread. You're buying the more expensive put and selling the cheaper one to finance part of the cost.
Your maximum profit is the difference in strikes minus your net cost, and your maximum losses is, once again, limited to that initial debit. It's a way to bet on a modest downturn with a clearly defined risk parameter.
This structure reminds me of placing a specific kind of bet. If you just buy a call, it's like betting on a team to win the championship at the start of the season. The payout could be huge, but the odds are long and it costs you to place the bet.
That's a great analogy. And a bull call spread, in that context, is more like betting that the team will win its next game by a certain number of points. The potential payout is smaller and capped, but the probability of being right is often higher, and the cost of the ticket is cheaper. You're not betting on a championship run. You're betting on a specific, more limited outcome.
Which brings us to the other side of the coin, credit spreads. Here, we're receiving money to open the position.
Exactly right. With credit spreads, you are a net seller of options premium. Your goal is for the options to expire worthless so you can keep the money. Let's look at the bull put spread. The name is a little counterintuitive at first. Bull because you want the stock to go up, or at least stay flat, but put because you are using put options. Here, you sell a put with a higher strike price and simultaneously buy a put with a lower strike price for protection.
So you're taking in a credit because the put you are selling is more expensive. It's closer to the current stock price than the put you are buying, which is further out of the money.
Correct. Let's stick with our XYZ stock at $100. To construct a bull put spread, you might sell the 95 strike put and receive, say, a $3 credit. At the same time, you buy the $90 strike put for protection, which might cost you $1. Your net result is a $2 credit, or $200, deposited into your account.
And what's the goal here? What do we want the stock to do?
This is the key difference. With the bull call debit spread, we needed the stock to rise above our break-even to make money. With this bull put credit spread, we make our maximum profit as long as XYZ stock stays above our short strike, 95, at expiration. If it does, both puts expire worthless, and we simply keep the $200 credit we received. We don't need a big move up, we just need the stock to not go down significantly.
It feels like a higher probability trade, but the risk must be structured differently too. What happens if the stock does fall?
The put you bought at the $90 strike is your protection. Your maximum loss is the difference between the strike prices, minus the credit you received. In this case, the difference is 5, 95 minus 90, subtract the $2 credit you took in, and your maximum possible loss is $3, or $300. This loss occurs if the stock price falls below $90. You collected $2 for risking $3.
So we have two different ways to express a bullish view. The bull call spread is a bet that the price will go up, and the bull put spread is a bet that the price won't go down. The choice between them would depend on your specific forecast, your risk tolerance, and the implied volatility of the options.
And naturally, there is a bearish equivalent, the bear call spread. You sell a call with a lower strike price and buy a call with a higher strike price. You receive a net credit, and you want the stock to stay below your short call to keep that credit. It's a bet that the stock won't go up past a certain point. The mechanics for profit and loss are the mirror image of the bull put spread.
What I find so powerful about this is how it changes the game for a trader. A simple long call or long put can be expensive, and time decay is constantly working against you. The break-even point can seem frustratingly far away. Spreads seem to address that directly.
They do. By selling an option against the one you buy, you immediately lower your cost basis in a debit spread, which pulls your break-even point closer. In a credit spread, you're essentially getting paid to bet on a certain price range, and time decay, or theta, is now working for you because you want the option's value to erode to zero. This defined risk nature makes them far more accessible and less intimidating than selling naked options, which carries, theoretically, unlimited risk.
So, to synthesize this, vertical spreads are a fundamental tool for risk management and expressing a nuanced market opinion. They are the definition of a defined risk trade. You are capping your potential upside, but in return, you are dramatically lowering your cost or even getting paid to enter the trade.
And you know to the penny what your maximum possible loss is before you ever commit capital.
That is the essential takeaway. When you expect a modest rise in a stock, you might choose a bull call spread or a bull put spread. When you expect a modest fall, a bear put spread or a bear call spread could be your tool of choice. The critical discipline is to always be clear on your maximum gain, your maximum loss, and your break-even point. Spreads force you into that discipline, turning an open-ended bet into a calculated play with clear, unchangeable boundaries.
Welcome back to the Options Playbook. In our last discussion, we focused entirely on vertical spreads, strategies designed to express a clear directional view, bullish or bearish, while strictly defining our potential risk and reward. They are surgical tools for when you have a strong thesis on a stock's modest movement. But that begs a crucial question. What if your conviction isn't about direction, but about magnitude? What if you're convinced a stock is about to make a seismic move, but you have absolutely no idea if it's headed for the stratosphere or the sub-basement?
That's the scenario where a purely directional playbook falls short. It's like standing on a fault line, knowing an earthquake is imminent, but having no clue which way the ground will shift. Today, we're exploring the strategies built for precisely this kind of uncertainty. We're moving from directional plays to pure volatility plays. We'll dissect the long straddle, a classic strategy for betting on a big move, and its close cousin, the long strangle, which offers a slightly different risk-reward profile. And most importantly, we'll discuss the specific market conditions like corporate earnings or major news events where these tools can become incredibly powerful, but also incredibly risky.
Exactly. We're shifting our focus from predicting the what and which way to simply predicting how much. Let's start with the most direct expression of this idea, the long straddle. It's a strategy that feels almost paradoxical at first glance because you are simultaneously taking a bullish and a bearish position on the same underlying asset.
It does sound counterintuitive, but it makes perfect sense when you reframe your goal. With a long straddle, you are not buying the stock's direction, you are buying its movement. To construct it, an investor buys a call option and a put option on the same stock with the exact same strike price and the same expiration date. Typically, this is done with at-the-money options to give the position maximum sensitivity to any price change. You're essentially placing a bet on both red and black on the roulette wheel at the same time. The catch is, you pay a hefty price for both bets, and the ball has to land in a very high or very low number, not just any red or black, for you to turn a profit.
Let's ground that in a concrete example to see how the profit and loss mechanics work. Imagine a stock XYZ is trading at exactly $100 per share, and there's a major earnings announcement scheduled for tomorrow. The market is tense. A big surprise could send the stock soaring or crashing. So you decide to implement a long straddle. You buy the at-the-money $100 strike call option, let's say for a premium of $5 per share. Simultaneously, you buy the at-the-money $100 strike put option for a premium of $4 per share. Your total upfront cost, your debit, is the sum of these two premiums, $9 per share or $900 per contract.
And that $9 cost is the most important number in the entire position. It represents your maximum possible loss. If the earnings report is a complete non-event, if the stock barely moves and closes at 100 on expiration day, both your call and your put expire worthless. Your investment in movement didn't pay off, and you lose the entire $900 premium. This is the worst-case scenario. The stock remains stagnant, and the volatility you paid for never materializes.
Now let's look at the upside, which is theoretically unlimited. For this straddle to be profitable, the stock needs to move away from the $100 strike price by more than the $9 premium you paid. This gives us two break-even points. On the upside, the stock must rise to 100 plus the $9 premium, so your break-even is 109. If XYZ rallies to say 120, your 100 put option expires worthless, but your 100 call is now in the money by $20. After subtracting your initial $9 cost, you're left with a net profit of $11 per share. Every dollar it moves above 109 is pure profit.
And the same logic applies to the downside. The lower break-even point is the strike price minus the premium. 100 minus 9 gives us 91. If the earnings are disastrous and the stock plummets to 80, your call option expires worthless. However, your 100 put option is now in the money by 20. You subtract your $9 cost and walk away with an 11 profit. So you can see the position becomes profitable with a significant move in either direction. You were completely agnostic about the outcome of the earnings report. You only cared that it would be a market-moving event.
This structure is powerful, but that initial debit, the cost of the position, is a significant hurdle. And that's where the close cousin of the straddle comes into play, the long strangle. It operates on the exact same principle, betting on volatility, but it's constructed slightly differently to reduce the upfront cost.
Think of the strangle as the budget-conscious version of the straddle. Instead of buying at-the-money options, you buy an out-of-the-money call and an out-of-the-money put, again with the same expiration date. The call's strike price will be above the current stock price, and the put strike price will be below it. Because both options are out of the money, their premiums are significantly cheaper, which lowers the total cost to establish the position.
Let's use our same XYZ stock trading at $100. To build a long strangle, instead of buying the $100 call and put, you might buy the 105 strike call for a cheaper premium, say $3, and the 95 strike put, also for around $3. Now your total cost is only $6 per share, or $600 per contract, compared to the $9 for the straddle. Your maximum loss is now capped at this lower $6 premium.
This immediately seems more attractive, less risk, a lower barrier to entry. But as with everything in options, there is no free lunch. The trade-off for that lower cost is that the stock now has to move even further just for you to break even. You've essentially widened the goalposts. The position only starts to become profitable if the stock moves outside of the range defined by your two strike prices plus the premium you paid. It's like buying cheaper concert tickets that are further from the stage. You paid less, but you need the performance to be that much more spectacular for you to feel like you got your money's worth.
Let's calculate the break-evens for that strangle. On the upside, you take the call strike price of $105 and add the $6 premium you paid. Your upper break-even is now $111. On the downside, you take the put strike price of $95 and subtract the $6 premium, giving you a lower break-even of $89. Compare that to the straddle's break-even points of 109 and 91. With the strangle, you need an 11-point move from the center just to get back to zero, whereas the straddle only required a 9-point move. You paid less, but you're demanding a much larger move from the underlying stock.
This brings us to the critical question: when do you actually use these? The textbook answer is ahead of a binary event where a significant price swing is expected. Corporate earnings are the quintessential example. Others include clinical trial results for a biotech company, a major court ruling, or an FDA announcement. These are moments of extreme uncertainty, and that uncertainty is what inflates option premiums in the first place. You are essentially paying a premium to own the potential explosion in price.
And that's the key danger that many traders overlook. You are not just betting on a big move. You are betting that the move will be bigger than what the market has already priced in. Option prices are heavily influenced by implied volatility, or IV. Ahead of a known event like earnings, IV skyrockets as uncertainty builds. The premiums for both calls and puts become very expensive. You are buying the straddle or strangle when implied volatility is at its peak.
Exactly. This leads to a phenomenon known as IV crush. Immediately after the news is released, all that uncertainty vanishes. The market now knows the earnings numbers or the FDA decision. Regardless of whether the stock shoots up or down, implied volatility collapses, and this crush causes the price of all options to deflate rapidly. This means you can be right on the direction and still lose money. If the stock makes a move, but it's not large enough to overcome both the premium you paid and the value lost from the IV crush, the trade can still be a loser.
It's a brutal reality of these strategies. You might buy the $100 straddle for $9, and after earnings, the stock moves to 108. You were directionally correct and the stock moved a lot. But because of IV crush, your call option might now only be worth $8.50, and your put is worthless. You end up with a net loss even though the stock moved almost to your break-even point. Your thesis on a big move was correct, but it wasn't big enough to overcome the high price you paid for that uncertainty.
So the key takeaway here is that these are not simple strategies. Straddles and strangles allow you to bet on action itself, not on a specific direction, which is a unique and powerful capability. They profit from dramatic swings, up or down, making them suitable for highly volatile situations. However, you are paying a hefty premium for that privilege, a premium that is inflated by the very uncertainty you're trying to capitalize on. It's a constant battle against time decay as the value of your options erodes every single day, and a race to beat the market's own expectations.
That's the perfect summary. You need to be right about two things: that a significant move is coming and that the move will be larger than the one implied by the option's lofty prices. If the event turns out to be a dud, or the move is merely average, the combination of theta decay and IV crush can lead to a rapid loss of your entire premium. These are tools for capturing chaos, but if the chaos fails to show up, the cost of admission is steep. Welcome to the Options Playbook, where we turn complex strategies into actionable intelligence. In our last discussion, we explored how to profit from chaos, betting on big price swings with straddles and strangles regardless of direction. But what if you expect the opposite? What if you anticipate stillness?
That's the fascinating duality of the market. It can be a raging river or a placid lake. While last time we were buying volatility, today we're exploring how to sell it. We're going to construct strategies that create a defined profit zone on a chart, aiming to earn an income when a stock decides to stay within a predictable range.
So we're moving from betting on the breakout to profiting from the stay put. Specifically, we'll be deconstructing two of the most popular income strategies in the options world, the iron condor and the iron butterfly. We'll look at how they're built, the market outlook they represent, and the precise risk-reward trade-off you're making with each.
Exactly. These strategies are a significant step up in complexity because they involve 4 different option legs working in concert. But understanding them is crucial for any trader looking to develop a truly all-weather approach. They are built directly upon the principles of the vertical spreads we've covered, combining them to create something new. It's about shifting from a directional bias to a volatility and time decay-based perspective.
It sounds like we're building a machine designed to harvest premium while a stock remains calm. Let's start with the iron condor. The name itself is evocative. Break it down for us. What are the components?
An iron condor is essentially 2 vertical spreads sold at the same time. You are simultaneously selling an out-of-the-money call spread and an out-of-the-money put spread. The call spread is a bearish position, and the put spread is a bullish position. By selling both, you are making a non-directional or range-bound bet.
So you have a ceiling on the upside and a floor on the downside. You don't want the stock to go too high, which would challenge your call spread, and you don't want it to go too low, which would challenge your put spread. You want it to stay comfortably in the middle.
Precisely. The beauty of this structure is that because you are selling both spreads, you collect a net credit up front. That credit is your maximum potential profit. Your goal is for the stock price to remain between the strike prices of the options you sold. If it does that until expiration, both spreads expire worthless, and you keep the entire premium you collected.
And the risk is defined. That's a key component here. The options you buy in each of those spreads serve as protection.
Absolutely. The long call in your bear call spread caps your potential loss if the stock rockets upward, and the long put in your bull put spread caps your loss if the stock plummets. Your maximum loss is the difference between the strikes in one of the spreads minus the net credit you received. You know your exact risk and reward before you ever enter the trade.
I think an analogy would be helpful here. How can we visualize what an iron condor is doing?
Imagine you're a rancher and the stock price is a herd of cattle. You don't know exactly where in the pasture the herd will be, but you're confident they won't stampede over the far northern hill or down into the southern ravine. So you build two fences. You build a fence on the north side of the pasture and another on the south side. The iron condor is that pasture with two fences. The space between the strike prices of your short options, your short call, and your short put is the grassy pasture where you want the herd to stay. As long as they remain in that zone, you're profitable. The fences, which are your long options, are there to stop a total disaster if the herd does decide to stampede. You might take a loss if they push against the fence, but they can't run off to infinity.
That's a powerful visual. Let's ground this in a concrete example. Say we have stock XYZ trading at $100, and we believe it's going to be relatively stable for the next month. How would we construct an iron condor?
Okay, with XYZ at $100, we expect it to stay within a range, let's say between 95 and 105. To build the condor, we first sell the bear call spread. We might sell the 105 strike call and simultaneously buy the 110 strike call for protection. This is our upper fence. Then we construct the lower fence by selling a bull put spread. We could sell the 95 strike put and buy the 90 strike put.
So we have 4 legs: short the 105 call, long the 110 call, short the 95 put, and long the 90 put. By selling those 2 inner strikes and buying the outer ones, we collect a net premium.
Let's assume we collect a total credit of $3 per share, or $300 for one contract. If XYZ closes anywhere between 95 and 105 at expiration, all 4 options expire worthless. We keep the full $300 credit. That's our maximum profit. The profit zone is that $10 wide range between our short strikes.
And the loss? What happens if the stock moves sharply?
If XYZ rallies above 105, our bear call spread comes under pressure. The position starts losing money, but the loss is capped at the 110 strike. Similarly, if it drops below 95, our bull put spread begins to lose. The maximum loss is the width of the spread, in this case $5, minus the $3 credit we received. So the max loss would be $2 or $200. We are risking $200 to potentially make $300.
That's a very clear structure. Now, how does the iron butterfly differ? It sounds similar, but perhaps more focused.
It is. An iron butterfly is a more aggressive version of the same range-bound philosophy. With the condor, we sold an out-of-the-money call and an out-of-the-money put. With an iron butterfly, we sell an at-the-money call and at-the-money put. This is effectively selling an at-the-money straddle. Then, just like the condor, we buy further out-of-the-money options, the wings, for protection.
So if XYZ is at 100, instead of selling the 105 call and 95 put, we'd sell the 100 call and the 100 put. This creates a much narrower target.
Exactly. Because we're selling at-the-money options, which have the most extrinsic value, the premium we collect is significantly higher than with a condor. However, our profitable range is much, much tighter. The profit graph of an iron condor looks like a plateau, a flat top. The profit graph for an iron butterfly looks like a sharp tent or a steep mountain peak.
Let's use that same XYZ at 100 example for the butterfly.
We would sell one 100 call and one 100 put. To define our risk, we'd buy wings, maybe a 105 call and a 95 put. Because we sold the more expensive at-the-money straddle, our initial credit would be higher, perhaps $7. Maximum profit is achieved only if XYZ closes exactly at 100 at expiration. The further it moves from 100, the more that profit erodes, until it crosses our break-even points and starts to lose money.
So the butterfly offers a higher potential reward, a larger credit, but demands much greater precision from the stock's final price. The trade-off is a higher reward for a lower probability of achieving that maximum profit.
That is the perfect way to summarize it. The condor gives you a wide, forgiving posture. The butterfly gives you a high, narrow peak to land on. Both strategies are designed to profit from the passage of time and a decrease in implied volatility. but they express that view with different levels of aggression and precision.
This brings us to the core risk-reward dynamic. On the surface, collecting premium for a stock doing nothing seems like a fantastic deal. But there's no free lunch. What is the fundamental risk we're taking on?
The fundamental risk is that you are wrong about volatility. You are being paid a small, defined premium to accept a larger, albeit also defined, risk. The market is paying you to assume the risk of a sharp, unexpected move. These are high-probability, low-reward trades. You might win small amounts on 8 out of 10 trades, but that 1 or 2 losing trades can wipe out many of your previous gains if not managed properly. The risk is that the placid lake suddenly becomes a raging river, and the stock price blows past your protective wings before you can adjust.
So success with these strategies is a game of statistics and careful position sizing. You're relying on the principle that most of the time, stocks don't make outsized moves that the options market isn't already pricing in.
Correct. You are selling insurance, in a way. Most of the time, the house doesn't burn down, and the insurance company keeps the premium. But when it does, the payout is significant. The key is to make sure the premium you're collecting is sufficient compensation for the risk you're taking on, and to never risk more on a single trade than you can afford to lose. These are not set-and-forget strategies. They often require monitoring and adjustments as expiration approaches and the underlying stock moves.
To bring it all together then, we've moved from the volatility buying strategies of straddles and strangles to volatility selling strategies. We've constructed 2 four-legged structures designed for income.
Yes, the iron condor and the iron butterfly are foundational income strategies. They are built from the simple vertical spreads we've already learned, but they combine them to create a neutral, range-bound position. They are tools designed to profit from quiet markets and the relentless decay of time. The key takeaway is to understand the trade-off. You are accepting a capped small credit in exchange for taking on a larger, though still capped, risk. Know your range, know your break-even points, and most importantly, understand that you are making a specific bet that the future will be less volatile than the market currently implies.
Welcome back to the Options Playbook. In our last discussion, we navigated the intricate world of multi-leg income strategies like iron condors and butterflies, structures designed to create specific profit zones by combining multiple option spreads. But building these complex positions raises a critical question, one that separates amateur traders from serious risk managers. Once you have multiple positions on, how do they interact? How can one trade that goes bad threaten to sink your entire portfolio?
That is the central question. It's the transition from thinking about the individual instrument to conducting the entire orchestra. Today, we're zooming out from the single trade to the big picture. We'll be exploring how to manage your portfolio as a whole by understanding aggregated Greeks, the hidden dangers of correlation between your positions, and the powerful risk measures professionals use to see the forest for the trees. This is about managing your net exposure, because in trading, the whole is often far more risky or safer than the sum of its parts.
Exactly. We've spent a lot of time breaking down the Greeks, delta, gamma, vega, theta, for individual options contracts. We know that a long call has a positive delta, and a short put also has a positive delta. But what happens when you have 10 different positions in your portfolio? A few covered calls, some protective puts, maybe an iron condor, and your core stock holdings. Looking at the delta of each one in isolation is like trying to understand a hurricane by measuring a single gust of wind.
It gives you a piece of the puzzle, but not the full picture. The first and most crucial step in portfolio management is to aggregate your Greeks. You need to know your net exposure. This means summing up the delta of every single position you hold, stocks, ETFs, and every option, to get a single number, your portfolio delta. That number tells you your true directional exposure to the market. Similarly, you sum all the gammas to get your net gamma, and all the vega to get your net vega. These totals matter far more than the Greek of any individual trade.
So if I have 100 shares of SPY, my delta from that position is plus 100. If I then sell a covered call against it with a -40 delta, my net delta for that specific position is +60. But the real insight comes from applying that logic across everything I hold.
Precisely. Let's make this tangible. Imagine a trader's portfolio is heavily weighted in technology stocks, Apple, Microsoft, Google. They feel bullish on this sector long term. To generate some income, they also sell cash-secured puts on another tech stock, like Nvidia, whenever it sees a small dip. Now, look at this from a risk perspective. The stocks have a positive delta, meaning they profit as the market goes up. The short puts also have a positive delta, meaning they also profit if Nvidia stock goes up. On the surface, every position is aligned with their bullish view.
But this is where the danger lies. All of these assets are highly correlated. They tend to move together. A broad market downturn or negative news for the tech sector won't just affect one of these positions, it will likely hit all of them simultaneously.
That's the double whammy. When the market drops, their stock portfolio loses value. At the same time, those short puts, which were comfortably out of the money, are now rapidly gaining negative value. The losses on the puts compound the losses on the stocks. The trader thought they were making separate, independent bets, but because of the high correlation, they were actually just making one giant, concentrated bet on the tech sector. If they had calculated their net portfolio delta, they would have seen an extremely large positive number, revealing a massive unhedged directional risk.
This really highlights why diversification at the portfolio level is so critical. It's not just about owning different tickers, it's about owning assets that don't all move in perfect lockstep. An options portfolio on 10 different airline stocks isn't diversified. It's a single bet on the travel industry.
It's helpful to think of your portfolio as a single, large, complex financial instrument. Your job as a risk manager is to understand the characteristics of that one big instrument. Your net delta tells you how sensitive it is to a $1 move in the underlying market index. Your net gamma tells you how much that sensitivity will change. A large positive net gamma means your directional exposure accelerates on a rally and decelerates in a sell-off, which can be favorable. But a large negative net gamma, which is common for traders who sell a lot of options, is a significant vulnerability. It means your losses accelerate the further the market moves against you. You become short convexity, and a rapid, sharp move in either direction can be devastating.
So, if your portfolio has a net negative gamma, you're essentially betting that the market will stay relatively calm. You're collecting premium, but you're vulnerable to a sudden spike in volatility and a large price swing. This is a risk that you would be completely blind to if you only looked at each trade in isolation.
Absolutely. You might have 5 positions that are short gamma and only one that is long gamma. Without summing them up, you have no idea that your entire portfolio is structured like a massive short straddle, just waiting for a volatile event to cause significant damage. This is why professional trading desks have a risk manager whose entire job is to monitor the firm's net Greek exposures. They might have a rule: the desk's net gamma cannot exceed a certain negative threshold.
Beyond just summing the Greeks, how do sophisticated traders and institutions quantify this overall portfolio risk? I've heard terms like value at risk or VAR.
Right, VAR is one of the industry standards. In essence, value at risk answers a specific question. What is the maximum amount of money I can expect to lose on my portfolio over a given time frame with a certain level of confidence? For example, a one-day 95% VAR of $1 million means that on 95 days out of 100, you would not expect to lose more than $1 million. It's a useful statistical measure to put a single dollar figure on your total risk.
But it's a statistical probability, not a certainty. It doesn't tell you what happens on those other 5 days.
Exactly. VAR has its limitations, which became very clear during the 2008 financial crisis. A more intuitive and, in many ways, more practical approach for most traders is scenario analysis or stress testing. Instead of relying on statistical probabilities, you ask simple what-if questions. What happens to my portfolio's total profit and loss if the S&P 500 drops 10% tomorrow? What if the VIX, the volatility index, doubles from 15 to 30 overnight? What if interest rates unexpectedly rise by a full percentage point?
This seems much more direct. You're simulating a market crisis to see how your positions would hold up under extreme pressure.
It is. Most modern trading platforms offer tools to do this. There are profit-loss graph tools, often called a risk profile, that can show you a PL graph for your entire portfolio combined. You can see how your total profit or loss changes as the underlying asset's price moves. It visually reveals where your risks are clustered. You might see a huge, steep drop-off in your portfolio's value if the market falls below a certain price. And that visual cue tells you that you need to buy some protection, like a far out-of-the-money put, to hedge that cliff-like risk.
And these tools can also model changes in volatility. You can slide a lever to see how an increase in implied volatility would affect your net Vega and your bottom line. If you're a net seller of options, you'll immediately see your PL drop as volatility rises, even if the market price hasn't moved at all.
This is the heart of modern risk management. You have to move beyond a static, one-dimensional view of your trades. A sophisticated trader doesn't just place a trade. They immediately analyze how that trade alters the portfolio's net delta, net gamma, and net vega. They look at the risk graph to see how it changes the shape of their overall PL curve. They ask, does this trade increase my correlation to the tech sector? Does it make my portfolio more vulnerable to a volatility spike?
It transforms trading from a series of individual bets into a process of continuously shaping and managing a single unified risk profile. The goal isn't just to be right on any single trade, but to construct a portfolio that can withstand various market conditions and whose risks are understood and intentionally managed.
And that is the ultimate takeaway. Manage your options as an integrated part of your entire portfolio, not a standalone gambles. The moment you enter a second position, your focus must shift to the net Greeks and the correlation between all of your positions. One large, unhedged options bet can completely dominate the risk profile of an otherwise conservative stock portfolio. True risk management is done at the portfolio level, not the trade-by-trade level. Always be asking how each new position shifts your entire book's exposure.
Welcome back to the Options Playbook. Last time, we took a 30,000-foot view, looking at how the Greeks of individual trades aggregate to define the risk profile of our entire portfolio. We talked about net delta, portfolio gamma, and the hidden dangers of correlation. But what happens when we have to zoom back in? What happens when one of those carefully selected positions, one piece of that master portfolio plan, starts to go sideways?
That's the real moment of truth, isn't it? The spreadsheet says one thing, but the market is telling a very different story in real time. The perfect trade you designed is suddenly under pressure. The question that paralyzes so many traders is, what do you do now? Do you stick to the plan even if it's failing? Do you cut your losses and run? Or is there a third way, an art of in-flight course correction?
Precisely. And that art is what we're dissecting today. This isn't about just picking the right strategy, it's about actively managing it once it's live. We'll be exploring the playbook for trade adjustments, when and how to roll a position. We'll cover the tactical advantages of scaling in and out of trades to manage risk. And finally, we'll tackle the nuanced world of stop losses and profit-taking specifically for options, which is a very different beast from trading stocks.
It's the critical next step. If portfolio management is the grand strategy, what we're talking about today are the battlefield tactics. Having a predefined plan for these situations is what separates a systematic approach from an emotional reaction. It's the difference between a pilot navigating through turbulence by following procedure and a passenger just holding on for dear life.
A great analogy. So let's get into those procedures. The market moves against your short put, breaching a key support level. The impulse is to either close it immediately for a loss or stubbornly hold on, hoping for a rebound. What does the playbook suggest?
The playbook suggests you should have already decided what to do at this exact moment, long before you even place the trade. This is the core of trade adjustment.
The first and most common technique is rolling the position. Rolling simply means closing your current option and simultaneously opening a new one in the same underlying, but with a different strike price, a different expiration date, or both.
Let's make that concrete. Imagine we sold a 30-day put on stock XYZ with a $100 strike, collecting a premium because we believed the stock would stay above $100. A week later, negative news hits and the stock drops to $98. Our short put is now in the money and showing a loss.
Exactly. Panic is setting in. But we have options, no pun intended. We could roll down, which means buying back our $100 put and selling a new put, say $95. This moves our break-even point lower, giving the stock more room to fall without causing us further losses. Or we could roll out, keeping the same $100 strike, but closing our 30-day option and selling a 60-day option. This gives us more time for the trade to work out, and we'll almost always collect an additional credit for doing so because we're selling more time value.
And often you do both simultaneously, rolling down and out. You buy back the $100 put that's expiring in 30 days and sell a $95 put that expires in 60 days. This accomplishes two things. It lowers your risk by moving the strike further away from the current price, and it gives you more time for a potential stock recovery. But it's crucial to understand this isn't a magic wand. You are realizing a loss on the original $100 put, and the new credit you receive may or may not cover that loss.
That's the key trade-off. You're extending the duration of the trade and often increasing the capital at risk in exchange for a higher probability of the new position being profitable. You have to ask yourself, has my original thesis about the stock fundamentally changed? If the answer is yes, if that negative news was truly a game changer for the company, then rolling is just delaying the inevitable. It's what we call rolling a loser. In that case, the best adjustment might be no adjustment. The best move might be to simply close the trade, take the loss, and preserve your capital for a better opportunity.
So the decision to roll is deeply tied to the original thesis. If the short-term drop is just market noise, but your long-term bullish outlook is intact, rolling to give the trade more time to be right makes sense. If the company's foundation is cracked, you're just throwing good money after bad. This is why having predefined rules is so vital. For example, a trader might decide beforehand, if my short strike is breached, I will evaluate rolling. If the stock then breaks below the next major support level, I will close the position for a loss, no questions asked.
And this leads directly into another powerful management technique, which is less about fixing a bad trade and more about optimizing a good one or entering one cautiously. I'm talking about scaling. Just as you wouldn't commit your entire army to a battle at the first sign of conflict, you don't always have to enter your full position size at once.
So if your plan is to sell 10 contracts of a cash-secured put, you might start by selling 3. If the stock dips a little, giving you an even better premium on the same strike, you sell another 3. And if it continues to dip, you sell the final 4. You've now entered your full size, but at a much better average price than if you had entered all at once.
Precisely. It smooths your entry and gives you a better cost basis. But where I find it even more powerful is on the exit side, especially with winning trades. Let's say you bought a call option for $2 and the stock has a huge run-up. Your call is now worth $8. You have a 300% gain. The temptation is to hold on, hoping it goes to 10 or 12. But a sharp reversal could wipe out a huge portion of that profit in a single day.
The classic dilemma of greed versus fear.
Instead of it being an all-or-nothing decision, you can scale out. Sell half your position at $8. You've now taken $4 per contract off the table. Your initial cost was $2, so you have locked in a 100% profit on your entire original investment, and you still have half your position left to run. The remaining calls are now effectively playing with the house's money. Your psychological state changes completely. You can now manage the rest of the position from a position of strength, not fear of losing your gains. It's about methodically taking chips off the table.
This also helps combat one of the biggest challenges in options, which is the decay of time value, or theta. A long call that is deep in the money might not gain much more from the stock moving up, but it is still losing value to theta decay every single day. By scaling out, you're banking the profits that came from the stock's delta and gamma and reducing your exposure to that ticking theta clock.
Which brings us to the ultimate exit plan: stop losses and take profit orders. In the stock world, it's simple. If the stock drops 10%, sell it. But with options, it's far more complex.
It really is. An options price is a function of the underlying stock price, time to expiration, and implied volatility, among other things. A simple stop loss based on the options price can be a disaster. Imagine you have a long call, and the underlying stock doesn't move at all, but there's a volatility crush after an earnings announcement. The price of your option could plummet and trigger your stop loss even though your directional thesis wasn't wrong. You get stopped out by a change in Vega, not Delta.
This is why, for options, I advocate for alerts and mental stops rather than hard stop-loss orders in the market. Set an alert for when the underlying stock hits a certain price that invalidates your thesis. When that alert triggers, you log in and manually assess the situation. Is volatility also a factor? How much time is left? You make an executive decision. Or you can set a rule based on the trade's P&L. A very common one for defined risk trades, like credit spreads, is the 50% rule. If you risk $1 to make $1, you might decide to close the trade if it ever shows a 50% loss. That is, a loss of 50 cents.
And on the other side of the coin, the take profit point is just as critical, especially for premium sellers. Let's say you sell a credit spread and collect a $30 premium per contract. The maximum profit is $30. A very common professional approach is to enter a take profit order to buy it back once it's worth, say, $15. You're targeting 50% of the max profit.
And people new to options always ask, why would you leave that other 50% on the table? The answer is risk management and capital efficiency. That first 50% of the profit usually accrues much faster and with less risk than the last 50%. As an option gets closer to expiration, its gamma risk explodes. A small move in the stock can cause a massive percentage change in your P&L. By closing the trade early for a 50% profit, you free up your capital and eliminate that late-stage gamma risk. You can then redeploy that capital into a new trade with a better risk-reward profile. Don't be greedy for the last few pennies. They are often the most dangerous pennies to collect.
It all comes back to a central idea. Your trade management plan, your rules for adjusting, for scaling, and for exiting, is not a sign of weakness in your original thesis. It's the sign of a robust and professional process. The market is a dynamic environment. Your strategy for engaging with it must also be dynamic. Your initial trade setup is your hypothesis, but your management plan is how you run the experiment and react to the data as it comes in.
That's the perfect way to frame it. You have to enter every single trade with a clear plan for 3 scenarios. First, what will I do if I'm right? That's your take profit plan, maybe scaling out to maximize gains. Second, what will I do if I'm wrong? That's your stop loss or your criteria for closing the trade to protect capital. And third, what will I do if the trade goes sideways or challenges me? That's your adjustment plan, your playbook for rolling or hedging.
So the key takeaway is clear. Successful options trading is not just about finding a good entry. It is about defining the entire life cycle of the trade before you ever click the confirm button.
Exactly. Have a plan for adjustments before you enter. Know your worst-case exit and your best-case exit. Use techniques like rolling and scaling with clear, logical reasoning, not as emotional, panicked reactions to a losing trade. Your management plan is what turns a single bet into a repeatable, long-term strategy.
Welcome to the Options Playbook, where we turn theory into a concrete game plan. Last week, we meticulously laid out the mechanics of trade management, the adjustments, the rolls, and the exits. We talked about having a pre-planned response for when a trade moves against you. But a plan is only as good as the person executing it. What happens when the market shifts? Your plan says to close the trade for a small managed loss, but a voice in your head whispers, just wait a little longer, it'll come back.
That's the critical question. It's the ghost in the machine. Why do traders who can perfectly recite the Greeks, analyze volatility skews, and build flawless adjustment plans still end up making catastrophic errors? The answer rarely lies in the numbers on the screen. It lies between our ears.
The logical brain that builds the strategy is often hijacked by a far more primitive, emotional brain when real money is on the line.
Exactly. And that is the entire focus of today's deep dive. We're moving from the external mechanics of the trade to the internal mechanics of the trader. We'll start by dissecting the most common emotional and cognitive biases that sabotage option traders, things like the fear of missing out, or FOMO, revenge trading, and confirmation bias.
Then, we'll shift from identifying the problems to building the armor against them. We'll cover two of the most powerful, non-negotiable tools for enforcing discipline. The first is systematic position sizing, moving beyond guesswork to a mathematical approach for determining how much capital to risk on any single idea.
And the second is the often overlooked but incredibly potent practice of keeping a detailed trade journal. This isn't just about logging wins and losses. It's about creating a feedback loop to identify and correct your own destructive patterns. It's about becoming your own trading coach.
The techniques we discussed for adjusting trades are the what to do. Today is about building the mental fortitude to actually do it when you're under pressure. Without this piece of the puzzle, even the most brilliant strategy is just a piece of paper.
Let's start by putting these biases under the microscope. They're often spoken about in general terms, but they manifest in very specific ways when it comes to options trading. Overtrading, for instance.
Overtrading is the constant need to be in the game. It's driven by a mix of boredom and a fear of missing a move. In options, this is particularly dangerous because of transaction costs and theta decay. You might see a stock with high implied volatility and think, I have to sell some premium, even if there's no clear directional edge or structural reason to do so. You're not trading a high probability setup. You're just feeding an addiction to action, and the bid-ask spreads and theta will slowly bleed your account dry.
Then there's its more aggressive cousin, revenge trading. This happens right after a significant loss. The logical part of your brain knows you should step away and reassess, but the emotional part feels wronged by the market and wants to win it back immediately.
And that's a death spiral. A revenge trade is almost always an oversized, poorly planned position. You might sell naked puts on a stock that just gapped down against you, massively increasing your risk, not because your analysis supports it, but purely as an emotional reaction to the prior loss. You're no longer trading your plan, you're gambling to soothe a bruised ego.
Let's talk about the fear of missing out, or FOMO. This one is rampant in the age of social media, where you see other people posting about massive gains. A stock is making an explosive move higher, and everyone seems to be getting rich off of it.
In the options world, FOMO is what makes people pay absurd prices for far out-of-the-money calls on a meme stock. The probability of profit might be less than 10%, but the fear of missing out on a 1,000% gain overrides all logic. It also works in reverse. If a volatility spike is happening, FOMO can pressure you into selling premium at any price, without considering whether the underlying risk justifies the credit received. You're not making a calculated risk-reward decision. You're chasing the crowd.
And finally, let's touch on confirmation bias. This is the tendency to seek out and interpret information that confirms our pre-existing beliefs. Once we've put a trade on, we subconsciously want it to be right.
This is incredibly subtle and dangerous. Let's say you sold a cash-secured put because you believe a stock is undervalued. The stock then breaks a key support level and starts trending down. Your pre-trade plan should dictate an exit or an adjustment, but confirmation bias kicks in. You start ignoring the negative price action and instead spend your time on forums and news sites looking for bullish articles that tell you the stock is a coiled spring ready to bounce. You filter reality to fit your desired outcome, and that's how a small, manageable loss turns into a catastrophic one where you're forced to buy a stock far above its current market value.
All of these biases short-circuit the logical framework we've spent so much time building. They lead to a complete breakdown of risk management.
Think of it this way. Imagine you've sold a put on a stock, XYZ, trading at $105, and you collect a premium for the $100 strike put. Your analysis suggests a high probability it will stay above 100.
Then, unexpectedly, the company releases some slightly negative guidance, and the stock drops to $101. It's still above your strike, but the position is showing a significant unrealized loss because of the spike in implied volatility and the delta move. The emotional brain kicks into high gear.
The impulse is to panic. Fear takes over. You might close the trade immediately for a loss, even though your original thesis that the stock would hold the $100 level is still technically intact. You let the fear of a further drop dictate your action rather than your plan.
Or the opposite impulse takes hold, hope, which is just another emotion. You tell yourself, it's just a dip, it'll bounce back. You do nothing. The stock then drops to $98. Now you're in the money. Your plan might have been to cut the loss at $100, but now you're anchored to your entry price, thinking, I'll just wait until it gets back to my break even. This is the gambler's fallacy, hoping a losing streak will magically reverse itself. You've abandoned probability and are now operating purely on hope. A disciplined trader recognizes that every trade is a probabilistic bet. If you sold that put based on a 70% probability of profit, you must accept that the 30% chance of loss will happen, and you must have a plan for it.
So how do we combat this? How do we force ourselves to stick to the plan when emotions are screaming at us to do the opposite? The first line of defense is purely mechanical and mathematical: position sizing.
Exactly. This removes a huge amount of emotional decision-making before the trade is even placed. The simplest and most effective method for most traders is fixed fractional position sizing. This means you decide in advance the maximum percentage of your trading capital you are willing to risk on a single trade. For most professionals, this number is incredibly small, often between 1% and 2%.
Let's make that concrete. If you have a $50,000 trading account and you follow a 2% rule, the absolute most you can risk on any one trade is $1,000. That's your hard stop. This isn't your margin requirement, it's your calculated maximum potential loss.
Right. So if you're buying a long call for $4 or $400 per contract, the 2% rule on a $50,000 account means you can buy a maximum of 2 contracts. Your total risk is $800, which is below your $1,000 limit. If you are selling a credit spread with a width of $5, where the maximum loss is $500 minus the credit received, you could perhaps sell 2 contracts. The key is that it forces a cap on your greed. That sure win trade might tempt you to bet the house, but your sizing rule acts as a circuit breaker, preventing you from taking a risk that could cripple your account in one fell swoop.
For more advanced traders, there are concepts like the Kelly criterion, which is a formula to determine the optimal size of a series of bets to maximize long-term growth. While the raw formula can be aggressive, the core concept is powerful. You should size your positions based not just on your risk tolerance, but also on your perceived edge. A high-conviction trade with a clear statistical edge might warrant a slightly larger position than a lower-conviction trade.
But for 99% of traders, a simple 1 to 2% rule is the golden standard. It keeps you in the game. A string of 5 consecutive losses, which is statistically inevitable, only draws your account down by 5 to 10%, which is recoverable. If you were risking 20% per trade, that same losing streak would wipe you out. Position sizing is your survival gear.
If position sizing is your pre-trade defense, the trade journal is your post-trade analysis tool. It's the mechanism for learning and breaking bad habits. It's what separates a hobbyist from someone treating this as a serious business.
I cannot emphasize this enough. A journal is not just a spreadsheet of your entries, exits, and P&L. A truly valuable journal is a log of your decisions and your state of mind. Before you enter a trade, you should write down the answers to a few key questions. What is the underlying thesis? Why are you choosing this specific strategy? What is the implied volatility, and why do you think it's mispriced? And most importantly, what is your plan if the trade goes against you, and what is your profit target?
Writing it down forces clarity. It's a pre-flight checklist. It makes you pause and confront the logic, or lack thereof, behind the trade. It's easy to jump on an emotional impulse, but it's much harder to justify it in writing.
The real magic happens during the monthly or quarterly review. You go back over your losing trades, and you start to see patterns.
you might discover that almost all of your biggest losses came from trades where you broke your own rules. You averaged down on a losing put sale, or you held a long call through an earnings announcement when your plan said not to. You might notice a pattern of taking profits too early on winning trades, cutting your upside because of fear.
You become a data analyst of your own behavior. The journal makes your biases undeniable. You can no longer tell yourself, "I just had a string of bad luck." The journal will show you, in black and white, that you consistently sell premium when IV is already low, or you over-leverage yourself on Fridays hoping for a weekend theta burn. The data doesn't lie. It reveals the gap between the trader you want to be and the trader you actually are.
And that's how you improve. You identify one specific recurring mistake, say revenge trading after a loss, and you make a new rule. After any trade that closes for a max loss, I will not place another trade for 24 hours. You enforce it, you track it, and slowly you cauterize that wound and eliminate that destructive habit. Without the journal, you're just flying blind, doomed to repeat the same mistakes indefinitely.
So it really comes down to a two-pronged defense, a rigid mathematical approach to position sizing on the front end to limit the damage any single emotional decision can do, and a disciplined analytical review process via a journal on the back end to identify and systematically eliminate the behavioral patterns that cause those poor decisions in the first place.
It's about building a structure of discipline around your trading. Your mind is your greatest asset in this business, but it's also your own worst enemy. Fear and greed are hardwired into our DNA. You can't eliminate them, but you can build systems and processes to manage them. The goal is to ensure that your trading is dictated by your well-researched plan, not by a fleeting emotional impulse. That is the only path to long-term success.
Welcome to the Options Playbook. In our last discussion, we navigated the treacherous waters of trading psychology, focusing on how discipline and a solid mental framework are the bedrock of long-term success. We talked about conquering fear, greed, and the biases that can sabotage even the most well-thought-out strategies.
Exactly. But having the right mindset is only half the battle. A disciplined mind needs disciplined tools to execute its plan effectively. It's one thing to have a plan on paper, but it's another entirely to see it, stress test it, and manage it in the dynamic environment of the live market. That's where we're heading today.
We're moving from the why of disciplined trading to the how. How can we use technology not as a crutch, but as a lens to bring our strategies into sharp focus? How do we translate our theoretical understanding of risk into a tangible, visual, and manageable form before we ever put a dollar on the line?
To answer that, we're going to open up the Modern Trader's Toolkit. First, we'll explore the powerful features that are likely already sitting inside your brokerage platform, specifically risk graphs and advanced option chain analytics. Then, we'll look at dedicated scanning and screening tools that help us hunt for specific opportunities across the entire market.
And finally, we'll dive into the granular analytical aids, things like Greek calculators, expected move charts, and volatility skews. These are the precision instruments that help us fine-tune our trades. Think of this as progressing from the architect's blueprint we discussed last time to the engineer's diagnostic and monitoring systems that ensure the structure performs as designed under real-world stress.
A perfect analogy. So let's start with the tools closest to home, the features within our own broker platforms. Most modern platforms like thinkorswim or tastyworks offer something called a risk graph or a PL profile.
And this is so much more than just a number showing your potential profit or loss. It's a complete visual representation of a trade's life. Why is seeing the trade as a picture so much more powerful than just seeing the numbers?
Because numbers can be abstract, but a picture tells an immediate story. Imagine you're flying a plane. You could just have a digital readout of your altitude, or you could have an attitude indicator showing your plane's position relative to the horizon. The risk graph is that attitude indicator. It shows you not just where you make or lose money, but the shape of that profit and loss across a range of underlying prices at a specific point in time, usually at expiration.
So for a simple long call, you'd see a line that's flat up to the strike price, representing your maximum loss, the premium you paid, and then it slopes upward infinitely to the right.
Precisely. But where it becomes indispensable is with multi-leg strategies. Take an iron condor. Calculating your max profit, max loss, and 2 break-even points is simple arithmetic, but the risk graph shows you. You see the flat-topped tent of profitability between your short strikes. You see exactly where the position starts losing money and where those losses are capped. It transforms the trade from a set of numbers into an intuitive shape. You can visually confirm your break-even points and see the risk-to-reward ratio without doing any math. The platform does it for you, instantly.
It also allows for portfolio-level analysis. You can see how a new position might interact with your existing positions and how it changes your overall portfolio's delta or theta. It's about seeing the entire landscape, not just the single tree in front of you.
And it's not just about the static picture at expiration. These tools allow you to model the PL line for any date between now and expiration. You can see how time decay or theta will impact your position's value even if the underlying stock price doesn't move an inch. You can see how a spike in implied volatility would warp the shape of that PL curve. It's like a simulator that allows you to test your trade against various future scenarios before you commit capital.
Beyond the risk graph, what other analytics within the option chain itself should traders be leveraging?
The option chain is a goldmine of data if you know where to look. Most platforms now display key metrics right there, like the probability of a strike finishing in the money or the probability of touch. These are derived from the options delta and the overall pricing model. So, when you're selling a put, instead of just guessing, the platform can tell you there's an 85% probability of that option expiring worthless. This quantifies your edge.
It directly reinforces the probabilistic mindset we've been emphasizing throughout the series.
It does. You can also analyze the term structure and volatility skew directly on the chain. Term structure is just the implied volatility levels across different expiration dates. Seeing a high IV in the front month but lower IV in later months might suggest a near-term event like earnings is driving the premium. Conversely, rising IV in longer-dated options suggests the market is pricing in more uncertainty down the road. The volatility skew, or the smile, shows you the difference in IV between out-of-the-money puts and calls. A steep skew with puts having much higher IV than calls is a classic sign of market fear. These are clues about market sentiment that are invisible if you only look at the stock price.
So the broker platform gives us the microscope to analyze a specific trade, but the market is vast. How do we find the right stocks or underlying assets to analyze in the first place? This leads us to our second category, scanning and screening tools.
This is where we move from analysis to discovery. A scanner is like having a team of analysts working for you 24/7. Instead of manually looking through charts of hundreds of stocks, a screener automates the search based on your specific criteria. It filters the entire market down to a manageable list of candidates that fit your strategy.
What are some concrete examples of criteria one might use in an options-focused scanner?
For a premium seller, the most common screen is for high implied volatility. You aren't just looking for high IV, but high IV relative to that stock's own history. This is called IV rank or IV percentile. So you could run a screen for all stocks in the S&P 500 with an IV rank greater than 80%. This immediately gives you a list of underlyings where the options are currently expensive, making them prime candidates for strategies like short strangles or iron condors.
So it automates the first step of the premium selling playbook, find rich premium.
Exactly. You can get much more granular too. You could screen for specific strategy patterns. For instance, you could scan for stocks that are ideal for a covered call strategy, perhaps stocks that have a certain liquidity, are in a slight uptrend, and have decent premium in their short-term call options. Tools like Option Samurai or ORATS are specialists in this, and many brokers have powerful screeners built right in.
Option Samurai even has add-ins for Excel or Google Sheets, allowing you to build very customized models and run scans on your own portfolio.
It sounds like it's about creating a systematic process for opportunity discovery, removing the randomness and emotional impulse of just trading whatever name is in the headlines that day.
That's the core of it. It's about efficiency and discipline. A good fisherman doesn't just drop a line anywhere in the ocean. They use sonar to find where the schools of fish are. A scanner is your sonar. It points you to the most fertile ground for your specific strategy, so you can spend your valuable time analyzing a handful of high-probability candidates instead of boiling the ocean.
This brings us to the final level of our toolkit, the more specialized analytical aids. We found a candidate with our screener, we visualized the trade with a risk graph. Now, how do we fine-tune the details? Let's talk about things like expected move.
The expected move is one of the most practical and underutilized tools, in my opinion. It's a statistical calculation based on the implied volatility of the at-the-money straddle, and it tells you the one standard deviation range the market is pricing in for a stock by a certain expiration date.
In simpler terms, it's the market's consensus on the likely trading range for the stock over the life of the option.
Correct. And most platforms can overlay this range directly on a price chart. Seeing those bands, for instance, a stock at $100 might have an expected move of plus or minus $8 for the next monthly expiration, is incredibly powerful. If you're selling an iron condor, your immediate goal is to place your short strikes outside of that expected range to increase your probability of success. The chart shows you visually if your chosen strikes give you enough of a buffer. It takes the guesswork out of strike selection.
And what about Greek calculators? We know what the Greeks are, but how do these tools help in practice?
They allow for dynamic what-if analysis. A Greek calculator can instantly show you how your position's delta, gamma, or theta will change if the underlying stock moves up by $5 or if implied volatility drops by 10%. Before entering a trade, you can simulate how sensitive your position will be to different market movements. For example, you might see that a small move against your short strangle could cause the position's delta to grow very rapidly. This is a sign of high gamma risk, and knowing that ahead of time allows you to prepare your management plan. Will you adjust? Will you close the position? The calculator helps you anticipate these decisions.
And in today's world, much of this doesn't even require being chained to a desk.
Not at all. Mobile apps have become incredibly sophisticated. You can set up custom alerts for almost anything. You can get a push notification if the IV rank on a stock on your watch list crosses a certain threshold, like 50%. You can get an alert if the delta of one of your positions exceeds a level you're comfortable with. This allows you to monitor your portfolio and market conditions passively, freeing you up to focus on other things until your specific criteria are met and action is required. It's about using technology to be a vigilant but not obsessive trader.
Let's tie it all together then. We've gone from the big picture to the fine details. These tools aren't just isolated features, they form an integrated workflow.
Absolutely. A professional workflow might look like this. You start the day by running a scan for high IV rank stocks that also meet your liquidity criteria. The scanner returns a list of 10 candidates. You go through them one by one, looking at their charts and option chains. You find one you like, an electronics company trading at $250. You decide a short put spread looks attractive. You open the risk analysis tool in your platform. You model the trade, perhaps selling the 230 put and buying the 225 put. The risk graph instantly appears, showing you your exact max profit, max loss, and break-even point. You then overlay the expected move on the chart and see that the one standard deviation range for that expiration is down to 235. Your short strike at 230 is safely outside that range, which gives you confidence. You place the trade and you set an alert to notify you if the stock price drops below 240 so you can reassess.
Every single step of that process, from discovery to analysis to execution and management, was guided and validated by a tool. It's the perfect marriage of the human-developed strategy and the technological execution, which removes the emotional guesswork we talked about in our last episode.
That's the ultimate point. These tools are the guardrails for your discipline. When fear tempts you to close a good trade early, the risk graph reminds you of your original plan and profit zone. When greed tempts you to enter a trade without a clear reason, the scanner forces you to check if it even meets your predefined criteria. They don't trade for you, but they make it much, much harder to trade against yourself.
So the key takeaway here seems clear. In the 21st century, trading without leveraging these tools is like trying to navigate the ocean with a paper map instead of a GPS. You might get there, but the journey will be far more dangerous and inefficient.
Precisely. The best part is that many of the most powerful tools, like risk graphs and advanced option chains, are free and already built into your brokerage account. The barrier to entry isn't cost, it's curiosity. So spend time in your platform's paper trading mode. Click on the Analysis tab. Build a hypothetical position and see what the risk profile looks like. Run a basic screen. The more you use these features, the more you move from trading based on gut feelings to trading based on a visualized, quantified, and professionally managed plan. Avoid the blind spots, confirm your strategy, and let the tools help you execute with the discipline you've worked so hard to build.
Welcome back to the Options Playbook. In our last discussion, we focused on the sophisticated tools that allow us to visualize and manage risk, the scanners, the graphs, the calculators that bring a portfolio to life. But there's a form of risk that can't always be neatly graphed. It's a risk that lives in the very nature of the contracts we sell.
Exactly. It's the risk that stems from the fact that every trade has two sides. When we sell an option, we collect a premium for taking on an obligation. But what happens when the buyer on the other side of that trade decides it's time for us to make good on that obligation, potentially at a time we didn't expect?
That is the central question for today. We're diving deep into the mechanics and consequences of option assignment and exercise. We'll start by clarifying the fundamental difference between American and European-style options, which dictates when this can happen. Then we'll walk through the step-by-step mechanics of the assignment process itself, who does what, and how you find out.
And most importantly, we'll translate that theory into a practical playbook for managing assignment risk. We'll look at specific scenarios, like the risks tied to ex-dividend dates for covered calls and the capital requirements for short puts. This isn't just about avoiding surprises. It's about maintaining control of your portfolio and your capital.
We spent our last session learning to use our instruments to read the weather. Today, we learn what to do when the storm actually hits. The distinction begins with the two primary exercise styles, American and European. It's a crucial difference that many traders overlook until it's too late.
It truly is. At its core, the difference is about timing and flexibility for the option buyer. Most options on individual stocks in the US are American style. This means the buyer has the right to exercise their option to buy or sell the underlying stock at the strike price on any business day up until the option expires.
So the power is entirely in the buyer's hands. A European-style option, in contrast, can only be exercised at expiration. There's no risk of early assignment. You'll typically find this style on major index options like the SPX or RUT.
Think of it like a ticket. A European option is like a movie ticket for a specific showtime on a specific day. You can only use it at that one moment. An American option is more like an open-ended theme park ticket that's valid any day until the end of the season. The holder can choose the most opportune moment to walk through the gates. As a seller of that ticket, you have to be ready for them to show up at any time.
And because most of us are trading options on individual equities, we are almost always selling those theme park tickets. This means the risk of early assignment is a constant, even if it's not always probable. So, let's say a buyer decides to exercise their American-style call option that we sold. What happens behind the curtain?
It's a formal chain of communication that's incredibly efficient. First, the option holder instructs their broker to exercise the contract. That broker then submits the exercise notice to the Options Clearing Corporation, or OCC, which acts as the central clearinghouse for all U.S.-listed options.
The OCC is the intermediary that guarantees the performance of every contract. It ensures that for every buyer exercising, there is a seller who will fulfill the obligation. The next step is where the randomness comes in. The OCC doesn't know who specifically sold that contract to that specific buyer.
It just sees a massive pool of identical short contracts.
Precisely. The OCC then uses a predetermined, impartial algorithm to assign the exercise notice to one of its member brokerage firms that has clients who are short that same option. This is usually done on a pro rata basis. Then it's up to that brokerage firm to decide which of its clients gets the assignment notice. Some use a first-in, first-out method, while others use a random lottery. The bottom line for us as sellers, if you are short an in-the-money option, you could be the one chosen.
And that notice lands in your account typically overnight. You don't get a phone call asking if it's a convenient time. You simply wake up to find that you have either sold 100 shares of stock per contract or bought 100 shares of stock per contract. Your option position is gone, replaced by a new stock position with all its associated risks and capital requirements.
Which brings us to the most critical part of our discussion, how to manage this. The first rule of selling options is to always be prepared to fulfill your end of the bargain. This isn't a theoretical obligation. It's a conditional one that can be triggered at any time. If you sold a cash-secured put, you must have the cash set aside and ready to buy the stock.
And if you sold a covered call, you must be willing to part with your shares at the strike price. That seems straightforward enough, but there are nuances that can trip up even experienced traders, particularly around dividends.
This is probably the #1 cause of unexpected early assignments on calls. Let's construct a scenario. Imagine you own 100 shares of stock XYZ, trading at $118. You sell a covered call with a $110 strike price, thinking it's deep in the money and you'll just collect the remaining time value. The company then has an upcoming ex-dividend date for a $2 per share dividend.
An option holder is not entitled to receive dividends. To capture that dividend, they must own the actual shares before the ex-dividend date.
Exactly. So a savvy option holder will look at your $110 call. They'll analyze the remaining extrinsic value or time value left in the option. If that extrinsic value is less than the upcoming dividend payment, there is a clear financial incentive for them to exercise the call. They pay $110 per share to take the stock from you, collect the $2 dividend, and are better off than if they had just held the option.
And for you, the seller, the result can be frustrating. You're assigned early, you're forced to sell your shares at $110, and you miss out entirely on that $2 dividend payment. It's a classic case where the buyer's rational decision directly impacts your planned outcome.
It's like you've agreed to sell your car for a set price at the end of the month, but you left a winning lottery ticket in the glove box that expires next week. The buyer realizes this, shows up early with the cash, and demands the keys. They get the car and the lottery ticket, while you're left with just the agreed-upon price. You have to be aware of what's in the glove box.
This is where the tools we discussed in our last episode become critical. Your broker's platform will clearly list ex-dividend dates. Analytical tools can show you the breakdown of an options price into intrinsic and extrinsic value. You can see the risk coming if you know what to look for. Check your short calls on stocks with an upcoming dividend. If they are in the money and the time value is less than the dividend, the probability of early assignment is extremely high.
The same logic applies to short puts, though for slightly different reasons. Let's say you've sold a cash-secured put with a $50 strike. The stock is trading at $49.99 on expiration day. The option is 1 cent in the money. Many traders might assume no one would bother exercising for a 1 penny gain.
That would be a dangerous assumption. Institutional traders and market makers will almost always exercise any option that is even minimally in the money, because for them it's a risk-free profit, and they operate at a scale where every penny matters.
So you wake up Monday morning expecting your option to have expired worthless, but instead you find you've been assigned and now own 100 shares of stock at $50 per share. You've outlaid $5,000 in capital. This is fine if you were prepared, as a cash-secured put seller should be. But if you were using margin and the stock happens to gap down to $40 overnight on bad news, you're now sitting on a sudden, significant unrealized loss and a potential margin call.
The key is that once an option goes deep in the money, its extrinsic value collapses to near zero. It behaves almost identically to the stock itself. At that point, there's very little benefit to keeping the short option position open.
That's a fantastic point. If you sold a $50 strike put and the stock is now at $40, the option is trading for around $10, almost all of which is intrinsic value. There's maybe a few cents of time value left. You've already realized most of the potential profit from the premium decay. At that stage, you can often close the position, buy the option back for a very small net cost, and completely eliminate the assignment risk and the associated overnight headline risk. Why carry that risk for a few extra pennies?
It's about weighing the remaining reward against the lingering risk. If the reward is negligible, it's often prudent to simply take the risk off the table. Buy to close the contract and you sever that obligation entirely. No risk of assignment, no surprises.
Ultimately, every option you sell is a conditional obligation. It's a promise to either buy or sell stock at a set price. You cannot treat the premium you receive as a simple profit without acknowledging the serious commitment that comes with it. Always be ready for the what if.
So, if you sell an option, you must accept that you might be called upon to buy or sell the underlying stock at any point before that contract expires. The key takeaway is to always be prepared for that eventuality.
Have your collateral ready. That means having the shares available for a covered call or the cash set aside for a short put. And stay vigilant. Pay close attention to your in-the-money short positions, especially as you get closer to expiration or an ex-dividend date. Don't let a surprise assignment turn a well-planned strategy into a reactive, costly mistake.